Hello, welcome everyone. Before we dive into today's long session for as far as the FR is concerned, I want to walk you through this ACCA's FR's report for the March and the June 2026 setting. Now, this is the most recent one published and is directly shaping as far as today's revision plan is concerned. So, over the next 10 minutes, I go through the specific questions the examining team has highlighted, exactly what the candidates got wrong, and most importantly, how each of these ties into what we are about to practice together. Think of this as a roadmap for the session. So, if you haven't already, it's worth pulling up this report yourself onto the ACCA practice platform alongside the sample exam it refers to, right? So I'll refer to and I'll give the reference to the specific requirements as we go. So let's start. Now, if we look over here, like this is the main structure or how the report is basically structured over here, right? Three parts mirroring the exam itself. Now, the section A over here covers the four objective questions, right? A quick single concept items, but the examiner picked out four that a large share of candidates got wrong, right? Section B is a one case for the Relicus company, basically, which builds the three standards together. Like we had the held for sale over here, events after reporting period over here, and again, the new standard IFRS 18, the presentation rules over here, right? And then the section C is the big one, having the two full constructed question response over here. One is the Paget company, and then other one is the asteroid company over here, right? Now, one important reminder before we get into the details, FR is a continuous Kimura-based exam. So not everyone in this room who's already sat it saw exactly these questions, right? But the patterns, the specific mistakes, these are the representative of the whole sitting, overall speaking, right? So they are exactly what we should be drilling today, regardless of which variant you get. Done? Now, overall speaking, the question number one that we have over here, and this is a great one to open with because it's exactly the skill set which we are about to drill in this session as well. Now, the Florida company acquired 70% of the Silpa company partway through the year. And there's also an intra-group sale of the goods sitting unsold in the inventory at the year end as well, right? So two things happened at once. Number one, time apportionment of the subsidiaries result to only the 6 post-acquisition months. And second one is to eliminate the unrealized profit on these goods still in inventory, right? The correct answer to this question was 1.338 million over here. Obviously, now most candidates got it wrong. And the typical common mistakes was ignoring number one, the prorating altogether. I mean, dividing the subsidiaries' profits into the 6x, the pre acquisition and the post acquisition over here, right? So, this was a common first mistake over here. And they simply just added the subsidiaries total profit into the groups over here as well. And then the most common other one was forgetting the intra-group elimination over here, right? And some candidates managed to make both errors at once as well. I mean, they had no idea to segregate it up, and then they had no idea as far as to eliminate the intra-group, like, the balances as well. Some they were able to eliminate the intragroup balance, but they forgot to time portion the results over here. Now, why does it matter to us? Because this is the precisely the muscle we are building today. Again, the practice questions that I have in line with me over the, the next number of hours. I'll be discussing this point explicitly with you over here as well, right? So if this question feels shaky watching it right now, so you have to pay attention when we get there over there as well, right? Number one, this is the issue main which we have seen the students had related to mid-year acquisition and the unrealized profit. Now, the second question, it shifts to the IS 32, that is a financial instrument presentation basically. And the question over here explicitly asks that which of the four following instruments increases the total equity on issue, right? That was the non-convertible loan stocks, convertible loan stocks, redeemable preference shares, or the bonus shares over here. Now, obviously, the correct answer is going to be the convertible loan stocks over here because they are the compound instrument, and according to the presentation requirements of the IS 32 as well, we have to split them between the debt portion and the equity portion as well. So obviously, when we are going to split up the equity portion, we are going to ultimately have an increase into as far as the equity of the company as well. Now, interestingly and surprising, I mean, it was a surprise to me as well that most common wrong answer was the bonus issue. I mean, we all know that at the end of the day, if we do the double entry for as far as the bonus issue is concerned, that is, we debit the share premium, we credit the share capital, and eventually the totals, they still remain the same. But technically, the students, they correctly saw that the share capital was increasing, but they missed that the other component of the equity, like the retained earnings or the share premium, they were falling by the exact same amount. So there was no net change, right? And then the best thing is the next common error was picking the redeemable preference shares. Look, redeemable preference shares are the ones which have to be bought back by the company after a certain number of years. So they are the ones which are representing themselves as a liability on the company, right? And then they have a contractual obligation to pay the cash to the holders as well. So this was the liability, not the equity. So the lesson here is a conceptual one. Always ask whether the instrument in discussion, you know, it's going to create a genuine obligation to transfer the cash. If it does, it's a liability. But however, it's labeled as well, right? So this was the second point, the conceptual one, which the students had over here as well. Now, third question. This is something again related to as far as the IS 37 is concerned, the provisions, contingent liability, and the contingent assets. And this was one of the most widely missed answer question in the whole report. Now, four scenarios we had over here, A, B, C, D, and we had to pick the two that created a provision. Now, the correct answer over here is C and D over here because the question was straightforward that which events give rise to a provision under the IS 37. So C and D were the the correct answers over here. Now the point is, where did it go wrong? Now this was an insurance claim likely to be paid to the company, right? So the company was likely to get it over here. So technically there was no provision into this, right? And surprisingly, most candidates got it wrong. I mean, they thought that the insurance claim is something that, they'll be having as a provision or they'll be having as, a sort of a liability over here, right? So this is the, you can say the insurance claim that the students thought that maybe it's sort of a provision over here. But think about the direction of the cash flow over here. I mean, if you want to correctly answer it, then you have to think about the direction of the cash flows over here. This is the money coming in, right? Coming into the business, into the company, not an obligation going out, right? So that makes it a contingent asset over here, not a provision. And contingent assets are not recognized until and unless they are virtually certain to happen, right? Until and unless they are virtually certain to happen, we don't record the, the contingent assets over here, right? Now, the other trap was this warranty claim in the option B. There was a 35% chance of a warranty claim, right? Now, this warranty claim over here, 35%, that's below the probable threshold as well. So it's a contingent liability disclosed in the notes, not provided for as well, right? And then this, overall speaking, the takeaway for your own exam technique is simple. Always run through the three-part test explicitly: the present obligation, probable outflow, reliable estimate. Simple. Rather than the pattern matching, this sounds like it needs a provision or something. Always have this three-step approach over here. That if you have a present obligation, it has a probable outflow, and there is a reliable estimate available, you'll go for as far as recording the provision is concerned, right? Then, next thing in line, the question 4 that we have over here, it moves to IFRS 16 leases, right? And it had the payments in advance over here rather than in the arrears. And we have to, when it comes towards the lease now, we always have to read the details carefully over here, because it simply changes the interest calculations. Because if the payments are in arrears, then we have the whole liability at the start and we calculate the interest for the whole year. If the payments are in advance, we first minus the amount of the repayment from the liability, and then on the remaining balance, we calculate the interest, right? So obviously, it changes the pattern for as far as the calculations are concerned. So over here, the correct answers, if you look over here, they were the interest of 1.04 million and the depreciation of 3.96 million over here, because the question simply asked that the 5-year lease, 4.1 million paid in advance, annual present value at commencement is 19.81, and then the implicit rate is 6.8%. Assets useful life is 10 years, right? So depreciation period, which one it asked about. Now, when we go as far as the depreciation period over here as well, we have explicitly learned about this as well, that if the title of the asset is transferred to the lessee at the end of the lease term, or the lessee has the option to buy the asset at the end of the lease term, then in that case, you depreciate the asset over its useful life. Otherwise, if there is no buyback option or there is no transfer of the title to as far as the lessee is concerned, then in that case, we simply go and we choose the shorter between the lease term and the useful life of as far as the asset is concerned, right? So over here, the lease term was 5 years, the life was 10 years. So automatically, the lower is the lease term. So that is what, we have to choose over here. And then look, the best part is nearly all candidates got the right interest payment, right interest. They got the right answer. And almost in half still got the depreciation wrong over here, right? So this is again a pure concept testing over here. And just the ground segregation that we have learned and created on the day one, they got deviated from it. So technically they got the answer wrong over here, right? Okay. Now, the next thing in line, we have this section B scenario over here, right? And this was held for sale and events after the reporting period. And this section B's case over here, the question in discussion over here is basically, this is Relico's company over here. And it's a good one as well because it focuses on three standards: IFRS 5, IS 10, and then we had the IFRS 18 over here, the presentation rules as well. So The first theme was the adjusting versus the non-adjusting events over here. So a court case settled after the year end that relates to the conditions existing at the year end. Obviously, they are going to be adjusting. Same with a customer's post year and bankruptcy, which usually confirms the receivable was already impaired as well. But a storm damaging an asset after the year end or the change in legislation after the year end, they are the non adjusting ones, right? So they relate to the conditions arising after the reporting period. So this was a comprehensive testing for as far as the IAS 10 is concerned. Secondly, as far as the property reclassification is concerned, and that was from the held for sale. Obviously, when you want to classify the property as the held for sale is concerned, then obviously you first have to revalue the asset under the IAS 16 now, and then obviously you'll go for the no profit, no loss impact only, and then you'll compare it with the revalued amount to the fair value less the cost to sell as well, right? So over here, if we go down into as far as the calculation and everything is concerned, this was something, the charge to as far as the profit and loss, that was 1.24 million, combining the depreciation up to the reclassification and the impairment on the reclassification as well. So basically, when you were supposed to reclassify an asset as a held for sale, you have to revalue it. And then obviously you compare it with the lower of the carrying value and the net disposal proceeds, and then you account for on that particular amount over here. The third theme over here is the equipment reclassification, and this is where most candidates basically they forgot to prorate the depreciation up to the actual date of reclassification, right? So basically, this was the 1st May, not the year end, right? So it was somewhere around in between or slightly before, the mid year, basically, right? So before applying the held for sale measurement rules, the careful reading of every date in the scenario would have avoided this over here. So before moving on, apart from the examiner's report, what I learned and got the main crust out of the report was that the candidates or the students normally they have a proper grip on as far as the computations and all related to the specific famous standards are concerned, but especially those standards which you have already studied, especially in the paper FA as well, like for example the IS 37, IS 10 as well, right? These are the standards where somehow some way the candidates they lack the knowledge in terms of the theoretical knowledge is concerned, right? So my strong recommendation even in the regular classes has been on these, that you have to ensure that these basic standards, which are basics, I call them basic standard because we have already covered them in the FA as well. So you have to have a very concise and you have to have a very focus, on these standards as far as from the theory point of view is concerned, right? So you have to do a proper theory coverage as well. So my lecture notes from the regular classes, right? My notes are over there to help you out in this. So just read through the lines, right? And the main points, just keep them in your mind, and then you can move on with that as well. Now, next thing over here, this is the section C question over here. And this is the Pidgeot Company question. And overall speaking, the goodwill on the acquisition, this was something which was well answered over here. This was the first requirement, and it was a straight one over here in the section C for as far as the goodwill calculation is concerned. Now, the consideration plus the non-controlling interest less the fair value of the net assets acquired, along with the general calculation. So the good news is basically this was generally well answered. Most candidates scored highly over here in this part. But where the mistakes were and where some candidate lost the marks were that it was almost always the presentation, not the technique. So you lost the marks while presenting the answer is concerned, right? Workings that just listed numbers from the question without showing how they combine into the final goodwill figure. Forgetting to discount the deferred cash consideration to the present value, using the proportionate share of the net assets of the non-controlling interest when the question specifically said to use the fair value method. And one point, literally surprised the examination team, and that was some candidates did not realize that the net assets simply equals the equity. That is the assets minus liability, simply, which is meant to be assumed knowledge coming into as far as the FR is concerned over here, right? So it's assumed knowledge basically in as far as the FR is concerned. Okay. Now, overall, for the consolidation, my message is simple. This is a typical 100% confirmed, and they can be a very easy marks for you. A clean labeled performer, like the ones we have over here on the screen, right? This one that we have. And it's going to protect you from all of these errors happening. We'll be talking about later in the in the video related to as far as the consolidation and the consolidated accounts as well. So you just have to sit over there and you have to just go through all the workings, which I'm going to do over here as well, and they will ensure and they will help you to realize that how can easily we can get the marks. I have always stressed on this point even in the classes over here as well, that always focus on the presentation side as well. Always try to focus on as far as the workings are concerned, because they are the ones which are eventually going to help you over here as well, right? Then the interpretation part, the real problem. Now, this is the most important one as far as in the whole briefing we are concerned. So I want to show you down here, and I want to tell you about the main thing over here, that is the Paget company's main requirement, the 11 marks, which asks the candidates to analyze and interpret the group's performance and the position compared to the parent alone in the prior year over here. And the best part is the examinations team's verdict was blunt. Most candidates basically they scored poorly over here. And it wasn't a knowledge problem, basically, to be honest with you. It was an exam technique problem, right? Now, this has now been a recurring comment across the multiple settings, which I've always came across, that this analyzing part question, this is something which is almost always poorly answered, right? So for this, I am going to give you a 4-step fix the examiner is explicitly and specifically and effectively asking for. Number one, link every point to the scenario. Whatever you write, you have to link it with the scenario. No marks for reciting what a ratio measures in an abstract. Simple. I mean, if you say that the gross profit percentage calculates the gross profit percentage related to the sales or something, or the ROS calculates the return on the capital employed of the company, you're not going to get any mark for that, right? The point is, whatever you write, you have to explain the ratio increasing or decreasing related to the scenario, that what's the reason for the increase or decrease. Number two, explain the mechanism. Explain the mechanism, right? Just don't say a ratio moved, it increased or it decreased, right? Like you have to explain specifically why using the facts from the scenario. Done. Third point, that is develop the point further for the extra credit. Simple. Like for example, noting that one-off costs for this year should mean an improved margin the next year. right? Or a one-off cost or one-off revenue this year means the revenue is going to decrease the next year or something, or it's a month of movement. So that is why the current year accounts are being impacted over here. And then the fourth one, give a genuinely separate conclusion under its own heading that directly references the specific transaction. Here, this was the acquisition of the Seattle company over here, right? So, this is basically what we have overall speaking. And then we have this example over here. This was the mid year acquisition explains the drop in operating profit, operating margin over here, right? Now, this is the weakest version for as far as the explanation or the interpretation was concerned, right? I mean, the better link or the better way would have been, you could have said that the decline to the acquisition cost and the redundancy cost actually mentioned in the scenario, they were mentioned in the scenario, right? So it goes further by noting these are the one-off. So the next year the margin should recover over here, right? So this is exactly the discipline we are going to enforce in every presentation and every interpretation as well, as far as this part of the question is concerned. And in session two, we'll be talking about explicitly related to the ratios, that how we can improve this up. Then, as far as the individual financial preparation presentation or the preparation was concerned, this was the asteroid company. That was a classic individual entity financial statements preparation question, basically. So we had a trial balance plus a set of, as far as the adjustment notes were concerned, and the candidates, they had to prepare a statement of profit and loss. They had to prepare a statement of financial position. Then a small statement of cash flow extract over here as well. Now, the five adjustments that mainly we had, the first one was for the lease, and the annual payment had been posted incorrectly to a lease payment expense account, and that had to be unwound because before the liability could be split into the current and the non-current elements over here. Secondly, it was the plant, a component with a shorter, 4-year life had to be depreciated separately from the rest of the asset, which has a 12-year life. Third, it was an intangible brand that have been wrongly capitalized. It should have been expensed as a selling cost. And the common error was actually subtracting the adjustment instead of adding it back, right? So you were supposed to add it back, but technically you got it wrong. And basically you just simply subtracted it out. And then the fourth and the poorly attempted overall, that was the contract asset under the IFRS 15, that was recognizing the revenue using an output method based on the units completed, not the units invoiced, right? And then obviously the fifth point always is going to be there, that is the current tax, right? Conceptually simple, but many candidates never got it because they ran out of the time over here, right? So the thread running through all five, each one is a self-contained testable skill. They all are the individual standards over here. So that's exactly we are going to drill them today in the questions or in the practice questions in isolation first, and then we'll go as far as the whole combination and everything is concerned, right? And then afterwards, uh, let's just talk about overall speaking, stepping back from the individual question, four themes cut across the entire report. And they are worth naming explicitly over here because they cost marks, regardless of how well you know the standards. They cost the marks, right? Remember, we have to show every working. I mean, if it's a typical on-demand paper, the CBE paper, right? If your final answer is wrong, you don't get any number. You don't get any number, right? If your final answer is wrong, you don't get any number because the marking team They can't award the on figure marks or something. That they can't give you the number over here. So use the spreadsheet tools properly over here, the formulas that you can use, not the calculator on the side. Try to use the tools over there which are available to you. Don't try to solve them on your own and just write the numbers over there, right? When you're going to do the presentation, when you're going to show the workings over there, even if your answer is wrong, but your workings are right, your concept is right, you can get the number. So this is a very important point, that always, always, always show the workings which you're doing, because the workings are the one which can give you the marks, not just the numbers that you put in into as far as your answer is concerned, right? So make this habit of yours, especially for the section C type questions, that you do perform well, you do disclose and do the workings over there for as far as the questions and everything is concerned, right? Number two, read and highlight every date: acquisition date, reclassification date, reporting period cutoff. Almost every error that we did happen to see into the report, it traces back to a date that was misread or not applied at all. So, I'm kind of sort of a person who simply underlines or highlights the date parts basically in the question, so that when you are picking up the figures, you do have an eye onto as far as what dates they are basically talking about over here. And then the third point, important one, that is, don't just observe, explain, right? Stating that a ratio went up or defining what it measures, it earns nothing on its own, right? Every point, it needs to connect to a specific fact, to a specific financial effect over here. So in ratio, we can't just simply get the marks now stating that what the ratio shows, or what basically happened to the ratio during the year. You have to connect it to the scenario. You have to connect it to the numbers, that why a certain ratio went up or why a certain ratio went down. And then the fourth major point is basically that you have to manage the time across the sections. The examiner noted that many candidates spent I can say at disproportionate time on the financial statements preparation question, leaving the interpretation question rushed. Interpretation marks are just as available, sometimes even more. So don't let the preparation eat into the time over here. You have to allocate the marks to the preparation side as well, right? Now, this point basically, as far as the time management and all is concerned, you can improve this thing as well, because now, from the past number of years, the papers are now computer based. Mostly, or what I have seen, during the classrooms as well, in the physical classrooms I'm talking about, mostly, still, this is a point, and this is something which needs to be addressed as well, that most students or the candidates, they prefer to solve on the page with a pen in a black and white form. And they are really very good when it comes towards as far as presenting, doing the questions, solving the problems, giving the test and everything is concerned. They are really very good. But what happens, that when they sit in front of a computer, in front of a spreadsheet, the whole speed, it drops. It drops. And why it does? Because they are not very much familiar, comfortable, and expert, not the expert, rather, but they're fluent in as far as using the Excel is concerned, right? So these things, they cost you the marks at the end of the day, right? Especially the fourth one. So now these whole four things that we have over here, when done consistently, would recover a meaningful number of marks across this whole report over here. Done. So basically, what this all examiner report that we talked about, what does it mean for us, or what crust we can take it out? Everything we have just walked through the maps directly onto today's plan. I mean, it maps the today's plan. The mid-year acquisition and the unrealized profit issue from the question one feeds straight into the roots and the branch company, right? That we are going to talk about. And then we are going to talk about the pastel and the gold company over here. I mean, the questions which we are going to do later. And then the interpretation technique that we had in the Puja company, basically, that is going to be related to and discussed in the section two, or the session two of the video that we are going to have over here. And then we'll apply that same four-step structure to the other questions as well, right? Specific standard gaps in the IS 37, IFRS 16, then the IS 32 as well, right? They get their own top-up blocks this afternoon as well. And the workings, the discipline, and the CBE habit points, they're not single block at all, right? So I'll be reinforcing them as we go and we do the questions, right? Now, this discussion is basically done over here to clearly give you the idea that simply preparing the paper from the conceptual point of view is not going to be enough. We have to work on our presentation skills as well. So, this is what we are going to do today. So, let's jump towards the questions that we have and let's talk about those. Okay, first thing in line, I have extracted these questions from the BPP exam kit, right? And I'll go step by step as already discussed in the report. First, I'm going to focus, I mean, this session I'll be focusing on as far as the group accounts are concerned and where we might have some issues as far as the concepts and all and everything is concerned, right? So let's start. We have the first question over here, that on what basis may a subsidiary be excluded from consolidation in accordance with IFRS 10, the consolidated financial statements? So basically, on what basis the subsidiary might be excluded? Now, technically speaking, there's no specific base. There is no point or rocket science or on the basis on which we may say that a subsidiary may be excluded from the consolidation. So the correct answer is going to be the option D over here. The reason being, the activities of the subsidiary, I mean, even if they are dissimilar, so what? It doesn't matter. We can consolidate. The subsidiary was acquired with the intention of reselling it after a certain or short period of time. So it doesn't matter. I mean, if it was acquired with the intention to resell, so what? And then again, the subsidiary is based in a country with strict exchange controls, which make it difficult for to transfer the funds. Look, even if it's a difficult for the transfer the funds over here, still we can go and we'll do as far as the consolidation and all is concerned, right? Then the next question that we have, this is the question 88 from the BPP exam, the latest one. Which two of the following statements are correct when preparing the consolidated financial statements? A subsidiary cannot be consolidated until it prepares the financial statements to the same reporting date as the parent. No, this is totally wrong. Even if the parent and the subsidiary, they have the different accounting year ends, it doesn't matter. You will still do as far as the consolidation is concerned, right? So this statement is wrong. And second one is a subsidiary with a different reporting date may prepare additional statements up to the group reporting date for the consolidation purposes. Yes, this is true. I mean, if feels like, if the parent feels like, then yes, the subsidiary with the different reporting date, it may prepare as far as the different, like, additional setups or the additional statements as well as the consent. So yes, it can. Then a subsidiary's financial statements can be included in the consolidation if the gap between the parent and the subsidiary reporting dates is 5 months or less. Uh, this statement that the subsidiary's financial statements can be included, if I talk about this question explicitly, the allowable gap between the reporting dates, that's 3 months. The difference or the date gap that you can have over here is 3 months. It's not 5 months, right? And the IS 27, it allows the subsidiaries to have a non-continuous year ends, provided several criterias over there, including the stating the reasons why the financial year end is different to the parent as well. So it's fine. I mean, you can go on with this. I mean, there's no issue. That so this statement is wrong over here, and then where the subsidiaries' financial statements are drawn up with a different reporting date from those of the parent, adjustments should be made for significant transactions or events occurring between the two reporting dates. True, the statement is true that we have to do as far as the adjustment and everything is concerned, right? And then we have the next question over here. IFRS 3 business combinations. It requires an acquirer to measure the assets and liability of the acquiree at the date of consolidation at fair value agreed upon. The parent company is required to report the assets of the or the liabilities of the subsidiary company to be reported at the fair value agreed upon. Now, the IFRS 13, the fair value measurement, provides the guidance on how the fair value should be established. So, identify whether the following factors are relevant or not relevant considerations when arriving at the fair value of a non financial asset according to IFRS 13. The characteristics of the asset, yes. I mean, obviously, you will have to see that what is the asset, what are its characteristics over here, right? Because technically speaking, you will have to see and you will have to talk about as far as the assumptions for the market, like participants are concerned when establishing a fair value of the asset is concerned. So yes, the characteristics of the asset, they are relevant over here. The price paid to acquire the asset. Now, this price paid, this is a historical cost one, and now what the value is going to be again in the market, this is not relevant. It's not relevant over here. And then the principal or most advantageous market for the asset. The principal or most advantage, yeah, true, it's going to be relevant over here because you will look at the primary market, right? You will take into account like how you are or how the asset is like going to be marketed in the market for the sake of the price and all. So yes, this is agreed upon, right? And then again, the highest and the best use of the asset, yes, this is relevant as well, because what can be the highest or the best use of the asset, this is something which is going to help you drive as far as the fair value of the asset is concerned. So this is true as well. This is relevant as well. Okay. Then we have the next question over here in line, and that is an investor company assesses control to determine whether or not it is the parent of an investee company. So according to the IFRS 10 consolidated financial statements, which three of the following are required to determine whether an investor has a control over the investee? So we have to look at the three of the following, which are required over here to determine if the investor has a control of the investee or not. The ability to use its power of the investee to affect the amount of the investor's return. True. I mean, if you are able to exercise the power and you can influence its operations, so yes. Exposure to or the rights to the variable returns from its involvement with the investee, yes, true. Acquisition of 50% or more of the share capital. And then we have the power of the investor. So I'll go with the power of the investor. This is true over here. But why I haven't chose this acquisition of 50% or more of as far as the share capital is concerned? Look, IFRS 10, it makes no reference to a holding of more than 50% of the equity shares of an investing company. Just by having more than 50% shares, it not necessarily gives you the control of the company here, right? Even if you might have a certain situation, but despite of having more than 50% of the shares, you're still unable to control the company or something, right? So it can be there. So just simply saying that if you acquired 50% or more of the share capital, you'll have the control over here. No, it's not correct. It's wrong. You're not going to be justifying with that point over here. Then Patrick Company owns 100% of the share capital of the following companies. The directors are unsure whether the investment should be consolidated. Okay. So, in which of the following circumstances would the investment not be consolidated? Right? Not be consolidated. Petrol Company decided to sell its investment in the Alpha Company as it is a loss making. The directors believe its exclusion from the consolidation would assist the users in predicting uh, the group's future profits. So what? I mean, if you or your subsidiary are incurring the loss just because of the fact that they're incurring the loss, it doesn't make them to explicitly get excluded from as far as the consolidation is concerned. So this statement is wrong, right? Then the beta company is a bank and its activity is so different from the engineering activities of the rest of the group that it would be a meaningless to consolidate it. No, it's wrong as well. You can have a consolidation or you can have a company or the subsidiary from the different operating background as well. So what? It doesn't matter. And then the Delta company is located in a country where the local accounting standards are compulsory and these are not compatible with the IFRS accounting standards. Okay, by the rest of the group as well. So what? I mean, if even if you have acquired and they have used some other accounting standards, obviously you will have to retranslate the subsidiaries results according to the international financial reporting standards before the consolidation. But this point only that their rule or their accounting standards are different or something, this does not make it excluded from as far as the consolidation is concerned. This statement is wrong. Then the fourth one, this is obviously only left, so this is going to be technically the answer over here. So this is going to be the Gamma company is located in a country where a military coup has taken place, and the Peter company has lost the control of the investment for the foreseeable future. Yes, this is something, right? Because the consolidation is not going to be appropriate over here in this case, as the parent has lost the control over here, right? Now, let's move forward towards as far as the next question is concerned. So this is the question that we have. This is the root company and the branch company case over here, right? So this is going to be related to as far as from 281 to 285 is concerned. And we have this one scenario, and then we have these multiple questions over here to be answered. Now, look, we have the information in multiple paragraphs, or we can say in the lines, right? So the approach over here is we'll be talking about, or we'll be reading first this paragraph, and then we are straight away going to jump on the first question without reading the rest, right? Apply this approach in order to save the time, because obviously the report says the students or the candidates, they're not able to complete their whole paper as well. So this is how we are going to learn by this that how we can save our time in the paper as well. No need to read the whole question straight away. Just read the first paragraph, do the first question, and then you can go as far as the other half is concerned. So let's start. On 1st April 2007, Root Company acquired 116 million of the branch company's 145 million ordinary shares for an immediate cash payment of 210 and issued at par 10% $100 loan note for every 200 shares acquired. So the question is requirement first one. What is the total amount of consideration transferred by the root company to acquire the investment in as far as the branch company is concerned? So we have, look, I'm going to go over here and do some formatting work. Now, we have the cash and we have the figures in the millions, right? Now, I made a cash payment of 210, so this is going to be over here. And then I have issued the loan notes over here, right? For every 200 shares acquired. So I have the loan notes, and the rule is $100 loan note for every 200 shares acquired. I had 116 million shares, right? So the working over here is going to be 116 million shares into $100 loan note for every 200 shares, right? Okay. So this is going to be into 100 by 200. So we get around 58 million over here. And this is the 210 million over here. Now, so this is the 58 million. Now. So I'll have the 58 million over here. So the total that I am going to have over here, this is going to be 268 million over here. So this is going to be my answer, right? So this is going to be my answer. And if I go into the answer, I will be writing 268 over here, right? Now, the first paragraph down, look, the second, what will be the amount of the adjustment in the group retained earnings? Huh? So I have to go into the second paragraph over here. So at the date of acquisition, branch company owned a recently built property that was carried at its depreciated construction cost of 62 million over here. The fair value of this property at the date of acquisition was 82 million. And then it had a remaining estimated remaining life of 20 years, number one. And then the branch company also had an internally developed brand which was valued at the acquisition date for 25 million, and it had a remaining life of 10 years over here. So what will be the amount of adjustment to the group retained earnings in respect of the movement on the fair value adjustments over here? So number one, I am going to look at my property, right? Now, if I talk about my property, a recent property that was depreciated, construction cost of 62 million, and the fair value of the property is 82 million, right? So the cost is 62. The fair value is 82, right? So the fair value adjustment required over here is of 20, right? So if you have this 20 over here, obviously you will have an excess depreciation on this property as well. Now, look, you acquired on 1st April X7, year end which we are talking about 31st March X9. So 2 years are gone, right? So the useful life is 20 years. So that's going to be 20. I mean, the fair value adjustment divided by 20 into 2. So we have a movement to be recorded in the accounts of the retained earnings of -2 over here. Similarly, we had a brand internally generated for 25 million. And it was though internally generated now, so the value is going to be 0 over here, and then we are going to record it because we have externally acquired it. So the fair value adjustment that we have over here is for the 25, and then excess amortization that we're going to have over here is 25 by 10 into 2. So that's going to be 5 over here. So the total movement is this is going to be -2 plus -5 over here. So we have a movement of -7 over here, right? So I'm gonna put up this answer over here. So 7 million is the movement. So this is going to be my answer over here, right? As simple. You just have to keep your eyes open related to what has happened over here. And then we have this next point over here. And this is the inventory of the branch company over here at 31st March 20x9 includes the goods supplied by the root company for a sale price of 56 million. And root adds a markup of 40% on the cost of to all sales over here. Okay, so we have this 56 million over here in the accounts over here, right? So what is the amount of the unrealized profit from the intra-group trading over here? This is what we have to tell over here. So this is going to be, look, simply, we have this breakup of sales, cost, and profit over here. So we have a selling price of 56 million. We have a 40% markup. So 40% is the profit percentage, markup is on cost. So my sales are going to be 140% over here. So 56 by 140 into 40, I get 16 million. I get 16 million over here as my unrealized profit over here, right? So that's going to be 16 million. Now, remember, if it's a markup, then the cost of sales, then the cost of sales is going to be 100, right? And I'm writing it for you over here that if margin, then your sales are going to be 100% over here, okay? If it's a margin now, then you have to put your sales over here. This is the cost, and this is the profit over here, right? So over here, if this is same case, 40% over here. So my sales are gonna be what, 100% over here, and then my cost is gonna be 60% over here, right? So if it's a margin, remember, then your sales are going to be 100% over here. Done? Okay. Next thing in line, 284. Using the drag and drop options available, show how should the unrealized profit be posted. Now, as far as the posting of the unrealized profit is concerned, the double entry, the unrealized profit, the rule is simple. We debit as far as our cost of sales is concerned, and we credit as far as our inventory is concerned, because we reduce the value of the inventory over here. So cost of sales debit, the inventories, they are going to have the credit over here, right? And then a straightforward double entry question, easy 2 marks. And then 25, branch company has recently lost some large contracts, and the directors of the root company are wondering if branch company can be excluded from the consolidation next year. So which would Or which of the following situations would allow a subsidiary to be excluded from the consolidation over here? So, which of the following situations are going to allow the subsidiary to be excluded from as far as the consolidation is concerned? The activities of subsidiary are significantly different. No, it doesn't matter. I mean, even if the activities are different, this does not allow you. The control of the subsidiary has been lost. Yes, if the control is lost, only in that situation you can exclude the subsidiary from the consolidated results. Otherwise, you cannot. Control of the subsidiary is only intended to be temporary. No. And the subsidiary operates under long-term restrictions which prevent it from transferring the funds. So what? I mean, uh, even if you cannot transfer the funds, but it doesn't matter. I mean, you will still do as far as the consolidation is concerned, right? Okay, let's move forward. Okay, so the next question over here that we have is of the Ford company and the Alfred company. Now, on 1st November 2024, Ford company purchased 75% of the equity of the Alfred company for 650,000. The consideration was $35,001 equity shares in Ford company with a fair value of 650,000. Noted below are the extracts from the draft statement of profit and loss for the Ford company and its subsidiary, the Alfred company, for the year ending 31st December 20x4. So we purchased on 1st November 20x4 and we are consolidating it on the 31st December 20x4, right? The profits for the Alfred have been earned evenly throughout the year. So we have this information over here, after which we have this using the options below, show the balances on the share capital and the share premium accounts at 31st December 20x4 over here. Okay. Okay, so using the options below, what is the balance on the share capital and share premium account at 31st December? That is what we have to see. So if I go as far as for the part company is concerned, we have the amounts over here. So we have a share capital, we have a share premium as well. Share capital, equity share, this is going to be 200 over here, and this is 500 over here, right? The next thing, the consideration was 35,000. $1 equity shares with a fair value of 650,000. So here this is a $1 now. So new shares, if it's 35, so technically 35 is going to be added up over here because $1 each. It's going to be credited with the face value. And then all of the rest of the amount is going to be the share premium. So this 650 minus 35, we get 615 over here. So the revised value over here, this is going to be a 235, and this is going to be 1115 over here. So the total is going to be 1350 over here, right? So the total is going to be 1350. I'm just gonna cut and paste it right in front of the question so that we can relate it with as far as the answer is concerned. Okay, so basically it's asking show below the balances on the share capital and share premium. Okay, so 235 for the share capital, which is going to come in over here, and then 1115, which is individually for as far as the premium is concerned. So they asked for the individual, we have the individual as the answer. If they would have asked for the total, we would have given them the total as the answer. Now, what are the net assets of Alfred at the acquisition over here? Okay, now the net assets at acquisition, if I go up, this is the Alfred company over here. So I will have the share capital 100 over here. Then I have the share premium for 85 over here. And then we'll have the retained earnings over here as well. And we are going to have the pre-acquisition retained earnings. Now, we got it in November. November and December, 2 months are post-acquisition. Rest, that is the pre-acquisition over here. So we have the 331 over here. Okay, let me show you the working. 331 minus, this is the profit for the year 96 over here now. So 96 into 2 by 12 is what we are going to do over here. So 331 minus 96 into 2 by 12. So we have this 315 over here. So the total net assets is going to be 500 over here. Here we go. So the net assets at acquisition, they are going to be 500 over here. Then we have this 288. The accountant of the port company is finalizing the consolidated financial statements. The accountant of the port company is finalizing the consolidated financial statements. Which two of the following statements are true regarding the consolidated financial statements over here? Okay, so number one is the non-controlling interest share of profit of the consolidated statement of the profit and loss. Okay, the non-controlling interest, the share of the profit is basically the part of the consolidated statement of profit and loss. So yes, this statement is true because we technically take up the NCI from that. Then the goodwill on acquisition should be amortized over a period not exceeding the 20 years. Why? I mean, there is no threshold of this 20 years over there. So this statement is wrong. And then if a subsidiary is acquired during the year, its results are apportioned over the year of acquisition. So yes, this statement is true. That if the subsidiary is acquired during the mid-year or something, then obviously, its results, they have to be time apportioned. And then only the group share of the subsidiary's non-current assets are shown in the statement of financial position, right? So this statement is wrong over here. So we'll have the A and C over here. And then we have the 289. What is the amount of group gross profit for the year? Okay. So we have to find the group's gross profit over here. We don't have any adjustment over here in the accounts, right? So if I go, this is the gross profit now. This is the port company. This is the Alfred company. So the balance given over here, that is 330 over here. And no, sorry, there are 364 we have to take up for the gross profit over here. And this is the 240 over here. And out of the 240, we are going to have as far as the adjustments over here. So this is going to be 240 into 2 by 12 over here, right? We have to do the adjustment over here with the 2 by 12 over here. So we have 240 into 2 by 12, our share, which is going to be 40 over here. So this is 364. So when we do the total, that's going to be 364 plus 40, and that is going to be 404 over here. So that's going to be the answer, 404 over here. And then what is the group retained earnings? Okay, now the group retained earnings that we have to have over here. If I go, these are my retained earnings over here. One is the port company. One is the Alfred company over here. So we have the balance given over here. So we have the retained earnings of 2,900 over here. And for the Alfred, these are going to be the post-acquisition ones. And if I go into the post acquisition, these are the retained earnings. So this is 331 into 2 by 12. So that's gonna be uh 331. But yeah, this is the total one over here. Now we just have the 2 months over here. So we can simply have it on the basis of the 96 over here because it's just been 2 months now. So that's gonna be 2 by 12 over here. Yeah, that's gonna be 16, right? And then we have the group share over here, which is 75%. So out of the group share, we'll have this 16 into 75, that is 12. So the total is going to be 2900 plus 12, 2912 over here. So that's going to be 2912 triple zero over here. So this is what we have over here, and this is how we are going to do this out. I hope it's clear. Now let's move forward. Okay, so over here we have now this past accompanying question. This is basically from the section C type that we have over here. And the best thing that you have to do in these questions, whenever you go into the section C, you are just going to give a glimpse to the as far as the start of the question is concerned. So as soon as you see the Paisley and the Scottish, I mean the two different company names over here, you are going to straight away scroll down as far as to the requirement is concerned. Now, if I look, prepare the consolidated statement financial position of the Paisley Group as at 30th December, 31st December 20x9. As soon as you read the requirements, you are not going to jump anywhere else. You are going to come onto your spreadsheet and then you are going to make its format over here. And for the sake of the format, we'll go from the line number 2 up to the 37. It's going to be more than enough over here. And we are going to box it up over here. Now, let me just zoom it a bit for you guys. And over here, we will merge. You have these tools over there to merge as well. So this is going to be the Paisley group. And then you will merge the second line, and this is going to be the consolidated statement of financial position as at, and then you're going to see the date, that is 31st December 20x9 over here. Then stretch this column out, put up the currency signs over here. And now draw the format. We have assets, we have non-current assets. Leave around 3 to 4 lines over here. 1, 2, 3, 4 lines over here. Then write current assets. In the current assets, take the help from this side. You have inventory, receivables, and cash. So you write inventory, receivables, and then the cash. Leave one line for some unknown adjustment, maybe if there is any, right? And then write total assets over here. Then leave one line and write equity and liabilities. And for this, take the help from here. We have the equity shares, equity share capital. Then do write the share premium as well because this normally comes in over here. Then write the group retained earnings. Leave one line for any unusual item that might come in handy over as far as these equity portion is concerned. And then write non-controlling interest. Under it, write non-current liabilities. Leave 2 or 3 lines and then write current liabilities. Leave 2 or 3 lines and then write total equity and liabilities over here. Then put up the 2 lines over here in front of the two assets as well, total assets, and then we'll do some cosmetic formatting. Underline this current, and then underline the non-current liabilities, underline the equity, underline the current assets, non-current, and the assets over here. So the skeleton of the question has to be created first, which I did. And then we have some standard workings, which you are always going to do. The working one, which you are always going to do, is going to be called as the group structure. At the start of every question, you will make this up, right? You will put up the line like this. And this is the Passley company. And the second one, it is the Scottish company, right? And over here, you will put up whatever as far as the percentage holding is. Then you will go over here in the working tool. This is going to be the summary of net assets of, this is going to be the summary of net assets of, this is going to be, we are going to write the Scottish company. This is going to be at acquisition date. This is going to be at reporting date over here. So from the acquisition date, we will be able to do the calculations for as far as the goodwill are concerned. And from the reporting date calculations, we will be able to find the figure for as far as the NCI is concerned. So we'll have the share capital, share premium, retained earnings. Obviously, at acquisition date, we will have the pre-acquisition retained earnings. And over here, we will have the total retained earnings. And I'm going to highlight this working too for the examiner as well, so that when examiner see my question, my constructed response over here, he can easily identify where are the workings over here. Then I'm going to go over here, right under the statement of financial position, I will write group retained earnings. I will highlight this as well. So I have this Basket company, leave one column, right? Scottish company. I'll put up the currency signs. I'll write balance given, and then I will write the post over here. Then leave around 4-5 lines and then write this as working for, and do highlight this as well. Right now, this whole over here, what I have done, let me just zoom it out. Look, this whole over here is going to be your standard working, standard format, which you always have to prepare before you jump onto as far as the solving the question is concerned, or getting into, or or involving with as far as the question is concerned, right? So remember this point always, because this is going to be really very, very, very crucial over here for as far as the getting the maximum out of for as far as the question is concerned, right? Okay, now let's zoom in back. So now let's just go to the start of the question, and this is on 1st July 20x9, Passley company paid 100 million in cash to acquire 80% of the Scottish company. So on 1st July, the company paid 100 million to acquire 80% of the Scottish company. So for this, I am now sure that as far as the percentage holding is concerned, that is 80%. So I will write it up over here. Done. And then I have paid 100 million only over here. So that is a cash consideration. I don't have any working over here to do with as far as the cash consideration is concerned. Otherwise, the cost of investment is concerned. Otherwise, I would have done the working over here. So I am just simply going to highlight this, that the company has paid 100 million over here. After that, what you have to do is just scroll down to the equity side and the retained earnings. Now, this is the Scottish company. I have 40,000 as far as of the equity shares is concerned. I will go over here. I will write 40,000 over here, 40,000 over here. I don't have any premium, so I won't write anything. As far as the total retained earnings are concerned, I've been provided with these. They are 81,700 over here, because in the financial position, I always get the total retained earnings. As far as the other retained earnings or the pre-acquisition retained earnings are concerned, I will be having the information in the points given below over here, in these points now, right? So I will just simply see that what are the earnings at the time when actually I had gotten the company. So I will simply see, and I will simply take them into account over here, right? Okay. Now, if I go into my point number one, it straight away says the fair value of the Scottish net assets were equal to their carrying amounts, with the exception of its head office. Okay. This had a fair value of 12 million in excess of its carrying amount. And at the date of acquisition, this had a remaining useful life of 10 years. Now, the best part is that we have an adjustment for as far as the head office is concerned because it had a fair value of 12 million in excess of its carrying amount over here. So I'm just straight away going to go over here in the working for, I will write head office, and with the head I can write the fair value adjustment as well. So I will write excess fair value 12 million, and on that remaining life is 10 years over here. This remaining life 10 years now. So I'll have the excess depreciation on head office over here. Now, if I go back, I acquired on 1st July, year end is 31st December, so it's been 6 months now. So I will simply go under this 12,000 into, but rather 12,000 divided by 10 years multiplied by 6 by 12, right? Because I have to time apportion the results because it's just been 6 months since my acquisition, 10 years was the life. So I will have the excess depreciation and I will show it like this 12,000 by 10 into 6 by 12. I get this 600 over here. Done? Now, as far as this adjustment is concerned, I have to now post it up. And how am I going to do this? Look, I have the group retained earnings. This is the head office of the Scottish company. I will have the retained earnings of the Scottish company over here. So I will simply go in working three. I will write excess depreciation working for, or I can write excess depreciation head office working for. I will go into the Scottish. I will minus the 600 from here. See, I have straight away accounted for this in the retained earnings over here. Because technically speaking, if I do the double entry over here, that has to be debit the retained earnings with 600, and then I have to credit the asset over here with the 600 for as far as the excess depreciation is concerned. And then we as a group have the right on the earnings over here. Similarly, the NCI has it as well. So I will write over here fair value head office working for. I will just stretch it out a bit like this. I will write 12,000 here, 12,000 here. Then I will write this as my excess depreciation working for. Nothing from the acquisition column, but from the reporting date, I will minus this 600 from here as well, right? And then if I go up, I have this property plant with me. So this is obviously a head office property plant. So I will write property plant. On the face, I will add 215 and 87,000. So 215 plus 87,000 plus 12,000 over here minus 600. And if you want to, you can add over here working for reference as well. I mean, if you want to add up the working reference, you can over here, right? So by this, we'll have working on the face, and we are telling the examiner that, look, we know that we have to add up the property plant over here as the head office over here. We have to do its adjustment into the calculation of the goodwill. We have to do its adjustment into as far as the NCI is concerned. And then we have to adjust, or we have to do its working in as far as the group retained earnings are concerned, right? So now, as far as posting all around, this has only been possible because I was creating, or I had already created the whole format over here. So with the help of this format, if I've already created, this is going to be a helpful link for me to identify where do I have to put up everything over here, right? Okay. Now, moving ahead from here, I have next thing in line, that is on 1st July 20x9, Passley Company also acquired 40% of Angus Company. Okay. So on 1st July, that is 6 months ago, right? When we basically acquired the subsidiary, the Scottish company, we got another company, Angus Company as well. So Pascal Company paid 30 million cash. In addition to this, Pascal Company issued to the previous owners of the Angus Company 30 million shares in Pascal Company, which had a market value of 2.3 each at 1st July 20x9. Now, the total consideration exceeds the group's share of Angus net assets. Pascal Company has only recorded the cash consideration over here. So basically, what happened that you have acquired Angus Company and you have acquired 40% of the Angus Company over here. So technically speaking, this is something which we are going to call as the investment in the associate over here, now, because basically in our learnings, in our regular classes, we when we started to study about as far as the consolidation is concerned, we learned this concept over there that whenever your percentage investment goes above the 50%, above the 20%, and you start to influence the operations of as far as the other company is concerned. So that other company is kind of considered as your associate because you are influencing its operations. So you start to do the associate accounting over here, right? So this is what I am going to bring in over here as far as the investment in the associate is concerned, right? So I'm going to go in over here. This is going to be working 5. Investment in associate, that is the Angus Company over here. I'm sort of going to highlight this up so that it's eye-catching for as far as the examiner is concerned. So it said that I have already recorded the cash consideration. So I have recorded the 30 million in cash. So I've recorded this cash consideration over here, right? And then it said that you have also issued 30 million shares, and this 30 million shares are at 2.3 each, and the Pascal company has only recorded the cash consideration, so the cash issue has not been recorded. So I will write the shares issued with a reference of working 5.1 over here. And I will go down bit maximum up to this point. So I will write maximum this working 5.1 shares issued to Angus Company, right? And over here, I will do the working. And this is 30 million shares at 2.30. 30 million shares at 2.30 over here. And over here, if we go up, equity shares of $1 each, right? So our shares, they have a nominal value or a book value of $1 now. So over here, my double entry to record the share issue is going to be debit. Investment in associate, I will credit my share capital, I will credit my share premium. Now 30 million shares, this is going to be at 2.30. This is going to be at 1, and then this is going to be at 1.30 over here, right? Now, if I go, this is 30 million, so that is technically 30,000 over here that I have to take into account. 2.3, I get 69. For the share capital, this is 30 million, so this is going to be 30,000, and over here, this is going to be 39,000. So I have written the amounts over here. These give a clear message to the examiner that we know that the share capital is always credited with the face value. This gives a clear message that the share premium is credited with the over and above the excess value which we have paid over here. And now this is something which is not recorded. So I can straight away, I can safely go over here. And as far as this working 5.1 is concerned, I can give the reference over here, and I can record this 69 thousand over here as well. And this share issue is not recorded, right? So I will straight away go up simultaneously. Over here, I give the reference of working, 5.1 in the premium. I will give the reference of working 5.1. So the share capital, which I already have, is 270,000. So there's 270,000 plus, I will have this 30,000 over here. I don't have any premium over here, right? So this whole premium, there's 39,000. This will straight away go over here because the reference has been given and provided that is working 5.1 over here. Now, coming back to the working five. So I have recorded the share issue over here. Done. Then what do we have next over here? And if I see the total consideration exceeds the group share of the Angus net assets, okay, no issues with that. Past the company has already recorded the cash. You can see duration over here. So with this, if I go up, I cannot see anywhere till now, till this point. If I go, I cannot see as far as the profit share of the Angus over here because in this point I have not been provided with as far as the profit share of the Angus is concerned. Now, this point, this is really very important. I have not completed my working over here because the investment in the Angus or investment in the associate, it's not yet completed over here. But the inherent limitation over here is in this point, I have not been provided that what is the profit for the year of the Angus company in which I can take out my share, right? So I'm trying to make you learn as far as the exam approach is concerned. And that exam approach is that, say, in case if the data is scattered, don't worry and don't get tense. All you have to do is, if this point is not telling you anything, now just move to the next point. And look over here in the very next point, point 3. Scottish company made a loss of 10 million for the year ended 31st December 20x9, and Angus company made a profit of 6 million for the same period. See, in the very next line, you get this information over here. So I go as the information takes me. First thing first, Scottish company made a loss of 10 million for the year ended 31st December 20x9. Now, if you remember, we got the Scottish and the Angus company at the same date, right? So this is the 10 million loss for the year. And it's been 6 months since our acquisition. So this 10 million's half is our share. So I will just straight away go up. Balance given the post earnings. 10 million is the loss into 6 by 12. I will write my post acquisition share of 5 million over here. Now look, my total retained earnings are 81,700. I made a post loss of 5 million over here. So technically the pre-retained earnings, I mean, if I go into the formula, look, let me write it up for here, then I'll raise it. Look, the total retained earnings of a subsidiary, they are pre-acquisition retained earnings, right? And then in those we add the post-acquisition retained earnings, right? Now, if I have my total retained earnings of 81,700, pre-acquisition retained earnings, I don't know, and my post earnings, my share is a negative 5,000. This is a negative amount. So if I have to rearrange, if I take it to this side of the equal, obviously this will be added. So this is 81,700 plus 5,000 over here. So that's going to be 86,700 over here. So I have posted the earnings of the Scottish company over here. Then, I mean, for now, over here in the workings where I have to do the adjustments and all. Now, as soon as I go into my second half of the point, Angus company made a profit of 6 million for the same period. It's been 6 months. So over here, I can simply write post acquisition profit share of, sorry, post investment or the profit share from associate, right? So in this, right under it, I have a 6 million profit multiplied by, it's been 6 months, multiplied by my share of 40%, right? So I will have this over here. And when I do this, I get 6 million into 6 by 12 into 40%. I get this 1200. So I get my total balance at year end, and this becomes 100, 200. Interesting amount, 100, 200. And as far as this post acquisition profit share is concerned, now I will give a small arrow over here and I will write a one single double entry to convey my message straight away to the examiner. Debit investment in associate with 1200, credit retained earnings of what's the name of the parent company? And that is Passley Company, retained earnings of Passley. So I credit the retained earnings of the Passley over here as my share of the profit from the associate is concerned, because the retained earnings, they are added up together. No? So I'm just straight away doing the double entry over here. Rather than going into the explanations and all, telling the examiner that, look, this has to be added into, like, as far as the investment and the associate is concerned, then it has to be added into the retained earnings. If I just simply do the double entry over here, it straight away, hardcore, straight away to the point, exactly to the point, it gives the message to the examiner so that you can secure your marks over here, right? So I have already given it over here. So I'll just scroll up. I will write profit share from associate over here. I give the reference of the working, and this is the working 5. See, and I'll go over here and I can simply write this 1200 over here. And then this is the investment in Angus, 100, 200. I'll straight away go up in the non-current assets. I'll write investment in Angus working 5. This was 100, 200 over here. So I will straight away write this amount 100, 200 over here in my non-current assets over here. Similarly, I have recorded it up into as far as the past is concerned, and this whole working is completed over here, right? I hope it's clear. Okay, now point number 4. Passley Company and the Scottish company both hold other equity investments over here. Okay, so they have some other equity investments as well. No election has been made to classify them as fair value through other comprehensive income. Now, you remember the financial instrument standard that basically, if we have equity investments, so when we acquire the equity investments now, we have to make an irrevocable choice at the beginning, at the start, that we are going to hold the equity investment till the end of time. So if no election is made, what do we do over there? We simply classify them as the investments or the fair value through profit and loss, right? So we'll just take whatever the movement that we have over here into the retained earnings. Now, no election has been made to classify them as a fair value through other comprehensive income. So at 31st December, these have increased by 15 million and 3 million respectively. But no entries have been made to reflect these. All these gains have been made in the post-acquisition period over here. Okay, so Pascal and Scottish company, they both hold the other equity investments, and these are at the 15 million, 3 million. Okay, so I'll go over here. I'm gonna write working 6 as equity investments, or I can write it as the other equity investments over here, right? Now, I have a Passley, I have a Scottish as well. I'll write balance at year end. So their balance at year end is 15 million, have increased by, the best part, see? Yeah, this is the point. They have increased by 15 million and 3 million over here, right? So they have increased by 15 million and 3 million over here. So the point basically over here is going to be you have to see that what is going to be their value now. So I have to go over here. This is going to be balance at start. Increase in investment is over here, which is 15 million and 3 million. And then we'll have the balance at year end over here for these. Now, if I go up, I have the investments. This is 297, this is 11,000. For as far as the Scottish is concerned, this is fine. There's no issue. But as far as for the Paisley is concerned, we have to do this working 7, that is the reconciliation of equity investments of Paisley. Or rather than writing, this is going to be the reconciliation of investments of Paisley over here. And this is going to be the balance given. Investments 297,000. I'm going to write the 297,000 less. I acquired 80% and this 100 million is paid over here. And this was included, right? This was included over here in the investment. So I will go and I will minus this investment in Scottish 100 million over here. Then I had the investment in Angus, which I did happen to see over here in the working 5. The cash consideration was over the 30,000, right? So this is the working 5 that I had. So I will minus this investment. So I have the balance of investment over here, and that is 167 over here, right? So this is the 167 over here. So basically, if I had the balance of this 167 over here, so this balance increased at the year end. So this is going to go at 182. This is going to go at 14. And then if I try to go for the total, this is going to go at 196,000 over here. Now, if I go as far as for the recording is concerned, this is going to be one this, and then this increase in investment as well. This has to be recorded now. Now, as far as the equity investments, I can go and I can record them separately for the Angus, for the Scottish separately, and then for I can write it separately for as far as the Paisley is concerned. Otherwise, I can write it as the consolidated equity investments working 6. And this is the working 6 over here, and the consolidated amount is 196,000. So I will write 196,000 over here, right? And then I have the increase in the investment, equity investment. This is the working 6. I will go up, and then gain on equity investment working 6. So for the Paisley, the gain is 15 million, and then for the Scottish, this is 3 million. I'll add up the 15 over here, 3 million over here. As soon as I write the 3 million over here, now I have to give its gain to as far as the NCI is concerned. So I'll go over here and I will write gain on equity investment working 6, nothing in the goodwill column. And then this 3 million, this is going to be added up over here for the NCI. So I have recorded my gains. Then I have recorded it in my assets as well, right? And then for the NCI. So this is how we are going to have it over here. Done. Now, moving ahead. We have next point, that is Scottish and Angus Company have both sold goods to the Paisley Company for many years. None of these goods remained in the group at 31st December 2009. Okay. So this is the best thing. We don't have this adjustment over here. because this is the intercompany transaction, but none of the goods are over here, because if they would have had been here, then we would have gone for as far as doing the adjustment for the unrealized profits and all that. But technically speaking, as they are not over here, so it's fine. But the second point is, Passenger Company's financial statement shows a 5 million payable to Scottish company. This disagreed with the amount of the receivable in the financial statements of the Scottish company due to a 2 million payable payment made by the Passenger Company on 30th December over here. Okay. So no issues with that. So now if I go, we have this intercompany balance over here. So this was the working 7. Now I'll go up over here. I'm going to call it as the working 8. And for the sake of the clarity and all, not up to this point, but up to this point maximum. Okay. Okay. I will just put up a line over here so that you don't get confused between the workings. So working 8, this is going to be intercompany balance. I will highlight it up. Now, Passes company showed are payable to Scottish. Okay. Passless payable to Scottish is 5 million. Scottish receivable from Passley is unknown, but not same due to cash in transit of 2 million. So technically, this is going to be 5 million plus 2 million, that is 7 million over here. So step 1, complete the transaction in transit. Step 1 is going to be complete the transaction in transit over here, right? So when we do so, when we are going to complete it up, we are going to have this debit cash with 2 million and credit the receivable with 2 million, and then eliminate the intercompany balance, and that is going to be the debit the payables with 5 million and credit the receivables with 5 million over here. Just simply record it up. Now we'll scroll up. First we have to record the cash. I'm gonna go in over here. So I have the cash 1300 and 9200 plus 2000. This one. Now I'll go to the receivables and I can give the reference over here for the working, and that is working 8. Okay, then I'll go to the receivables. Working 8 again. 37,100 plus 15,600. Right? So now from this, I'll do the direct working. 2 plus 5, 7 million. I'll straight away minus the whole 7 from here. Then I'll go to the current liabilities with my payables, working 8. If I go to the payables, 49,400 plus 18,300 minus the payables are the 5,000 over here. So I will minus the 5,000 from here. So technically, minus 7 plus 2, this is 5 deducted from here. 5 is deducted from here. So it's all balanced. Right? Okay. Now, moving ahead from here. Passley Company values a non-controlling interest at fair value. So at 1st July, the value was 29 million. Okay. So we have this value over here for the 29 million over here. Now, all else equal, all the points are done. Now look with a very focused point of view. We are done with the adjustments. Now I'm going to go over here. I will underline this here, underline this over here. So I have a total net assets over here. I'm going to do the work total over here, then the total over here. Then I have the percentage holding. I have 80% over here, 20% over here. So I will write the net assets acquired. So I acquired basically 110,960 of as far as the net assets are concerned. My cost of investment, which has been given to me over here, is 100 million over here. Right? So as soon as I write up the 100 million over here, this is, I get a negative goodwill, or I get a bargain purchase over here. And that's going to be 10,960 over here. I got the net assets of the Scottish company valued at 110,960 for just 100,000 over here. So I bought the net assets of the Scottish at a lower amount. So technically, if you go into the market and if the asset has a higher value, but you end up paying the lower value, so technically it's your gain, right? It's your gain now. So this 10,960, I will bring over here gain on, or I can say the bargain purchase gain on Scottish company working two, and this is going to be 10,960 over here as my gain over here. This will be called as my gain over here because I have bought it in a cheaper amount over here, right? I have bought it in a cheaper amount over here. Similarly, I will go with the fair value of NCI, and the fair value of the NCI, which is being given to me over here, is 29 million over here. So I will less the net assets at acquisition for the the NCI part over here. So that is basically 138,700 into 20% over here. So 138,700 into 20%, I get this 27,740. So goodwill portion of, as far as the NCI is concerned, that is going to be the 1260. So net bargain purchase, that is going to be 9,700 over here. So this net bargain purchase side of, as far as the NCI, is net 9,700. So rather than having the individual only, I'll take this into account as well, and then I will have this 9,700 over here. Similarly, as far as for the NCI part is concerned, this is going to be this 27 to 20, and then we'll have the goodwill share for the NCI, that is 1260, and then the total NCI over here is going to be 28 for 80 over here, right? So this is going to be 28 for 80 over here that we have over here. Done? Okay. Now, moving ahead from here, if I go into as far as my retained earnings are concerned now, I'll go over here. Let's do the total on both sides. So for the past day, my retained earnings are 214,300. Now, let's do the total over here, 240. And then this is 2,600. We have now the percentage holding 80%. So we have this into this 2080, and now I have to insert a line. Okay, so total group retained earnings, they are going to be the sum of this and this, 238,120 over here. Now, let's put up all the figures over here. So we have the group retained earnings. This is going to be the working three. And this is 238, 120 over here. NCI from the working two. This is going to be 28, 480 over here. Right? And no goodwill over here for us. Now, as far as this amount is concerned, this is going to be 215,000, 87,000, 12,000, and this was 600. Okay. So I'll minus the 600 from here, right? So I will underline this and the total will go out. This will be 609, 600 over here. Done? Okay. Now, as far as for the inventory is concerned, I'll put up the inventories 61, 300 plus 22, 500 over here. So this 61, 300, 22, 500, and then this is going to be 37, 100, 15, 600 minus 7,000, and then 1,300, 9,200, 2,000. This is going to be 12,500. So I have this 751,600 over here. Now, 270 plus 30,000 is going to be 300,000. I'll go down. I'll take the total out, and this is going to be 577. Then let's see. Do we have any non-current liabilities? Yes, we do. Loan notes, and that is 78,053. So that is 78,000. 5,300. So that's going to be 83,300 over here. As far as the liabilities, we just have the payables, which we have accounted for. So 49,400, 18,300 minus 5,000. So if I go out and do the total, I get 75,600 over here as well. So my total assets is equal to total equity and liabilities over here. So this is the approach that we have to adopt over here. So in this question, this was the interesting point as far as for the goodwill is concerned. It was a negative goodwill, so we had to bring its movement over here to record in the accounts, right? So this is the whole picture and the story over here. Now, time to move for the next question, which we are going to start in just about 1 minute only. Okay, now another question which I've chosen for you guys over here is basically this gold company question. The previous one we talked about as far as the consolidated statement of financial position. And this one over here, we are going to look into as far as the consolidated statement of comprehensive income. Because overall, it's been observed, the candidates overall or the students overall, basically, they get a bit stuck or they struggle a bit extra with as far as the consolidated statement of comprehensive income is concerned, not because it includes some sort of a heavy adjustments or something, but because of the unorthodox adjustments normally which we normally come and see across as far as the time apportionment of the expenses and the income is concerned. And mostly student they sort of forget this thing to do, or when it comes towards the adjustment of the intercompany transactions along with the unrealized profit and all, they do get stuck a bit over here, or when it comes at the end where we have to apportion the profit between the group and the NCI, they kind of bit struggle over there. So keeping these things in mind, I've decided to why not to go and have a practice of this question so that we can reinforce our understanding and our concepts over here. So let's start. We have this gold company over here. That is on 1st January 22 gold company acquired 19%. Okay, so we have the gold and the silver over here. We'll straight away scroll down 1, 2, 3, 4, 5, 6, 7, and 8. And then the requirement. Calculate the goodwill arising on the acquisition of the silver over here. And then prepare the consolidated statement of profit and loss for the gold company for the year ended 30th September 22. And all the workings are to be done to the nearest thousands over here. So nearest thousand we have to go into and we have to get the things done over here. So what we are going to do over here is this is for as far as you know the income statement or the consolidated statement of profit and loss is concerned. We are going to have this over here and this is going to be more than enough, the box. So we'll do the parallel workings over here. Over here we'll do as far as the consolidated statement of comprehensive income is concerned, and on this side we'll do the goodwill calculations over here. So let's start. We are going to merge this up. We are going to merge this up, and this is going to be the gold group consolidated statement of comprehensive income for the year ended 30th September 20x2 over here. Right? Okay. So I'll stretch it out a bit and then we'll have our currency signs over here. So over here, I'll have my revenue. I'll have my cost of sales. Then I will have my gross profit as well. I leave one line, then I have my selling expenses over here, general and administrative over here, and then I have my operating profit. So I'll copy it up. I have my selling expenses. I have my general and administrative expenses, and then I will write my operating profit over here. And then I have the income from investments over here, right? So profit before financing and income taxes over here. So I will leave like around 2-3 lines over here, and then I will write my profit before financing financing and income taxes over here, right? And then I leave 2-3 lines. I will write my profit before income taxes. I will write my income tax expense over here, and then I will write my net profit for the year over here. And then I will have this attributable to. Okay, let me just fix it up. We have a group, we have a NCI, and then we have a total over here, right? So this is going to be for as far as the consolidated statement of comprehensive income is concerned. And as I told you, we'll be doing the workings for the sake of the goodwill over here. And I will simply go and I will use the same approach. We have the calculation of goodwill over here. Okay. And for the sake of the calculation, the goodwill, we can go with the same approach over here as well. We can have the consideration paid over here, right? And then we can have the fair value of the NCI, and then we can have the net assets and all over here as well, right? So we can have the things around over here. Now, let's start. It says that on 1st January acquired, the year end is 30th September. So overall speaking, we have to time apportion the results of the subsidiary by 9/12 over here. I have written this over here in some big font over here. And the only reason for doing so is so that when we are doing the question, we just keep this thing in our mind that we have to time question the results of the subsidiary over here. Okay. Now, on 1st January 2022, Gold Company acquired 90% of the 16 million equity share capital of the Silver Company. Gold Company issued 3 new shares in exchange for every 5 shares it acquired in the Silver Company. Additionally, Gold Company will pay further consideration on 31st December 22 of 2.42 per share acquired. Okay. Gold Company's cost of capital is 10% per annum and the discount rate for the 1 year is 0.9091. And then at the date of acquisition, shares in the gold and the silver had a fair value of 8 and 3.5 respectively. So this is a good point and a hint over here for as far as the consideration paid over here. And we can simply have this consideration paid, rather we can have a good word, that is the transferred over here. Now, first thing first, we acquired the share capital Silver Company, so we issued our 3 share. So we have a share exchange over here, and for the share exchange, we got 16 million shares. We got the 90% over here, and 3/5, because for 3 new shares in exchange for the 5, so 3/5 is over here into my share price is gonna stand at the Gold Company. So it had a share value of $8 over here. Okay. So $8 is gonna come in over here as well. So my consideration share exchange, this is 16 million into 90% into 3/5 into 8. I get 69,120 over here, right? Then the second thing, I have this deferred consideration over here. And the deferred consideration is I will be paying further 2.42 per share. And this is going to be 16 million shares into 90% I acquired. I'll be paying 2.42 per share. And now my cost of capital is 0.90, it's 10%. So 1 year discount rate is 0.90901, 0.9091 over here. So I will have this deferred consideration as well. So 90% into 2.42 into 0.9091 over here. So that's going to be 31,680. Okay, so this is going to be the total cost of investment over here. And so right now over here with this same very point, I will go over here in my workings, and the working one, I have to tell the examiner that I have to take up the unwinding of discount for the deferred consideration over here, right? I have to take into account as far as the unwinding of discount for as far as the deferred consideration is concerned. And then if I look the present value of deferred consideration, this is 31,680. So we'll have the unwinding as 31,680 into 10% into, I got it on January, year end is September, so it's been 9 months. So that's gonna be 31,680 into 10% into 9/12. So that's gonna be 2,376 over here, right? And I will just simply go over here, profit before financing and income taxes over here. I will have it as the interest on, or the interest expense on unwinding of discount over here. So with the working one, I'll start off posting. This is going to be 2376 over here, right? So this is going to be 2376 over here. This is the interest expense that I have to account for over here as well. Okay. Now, moving ahead from here, we are done with this. Now, we have the statement of profit and loss. Okay. Now, the following information is relevant. And the information is at 1st October 20x1, the retained earnings of silver were 56 million. Okay. So on 1st October 20x1, the retained earnings over here, basically, they were 56 million over here. Okay. So technically speaking, if I go to this point, when I'm into the calculation of the goodwill now, obviously I have to less the net assets at acquisition. So I will have the share capital, I will have the retained earnings over here, right? And these retained earnings are normally the pre that I have. So on 1st October, the retained earnings that I have, right? So these are gonna come in over here, and that is 56 million over here. So I will write this 56 million. So profit from 1st October to 31st December. That's going to kick in as well. And this is going to be, I have a net profit for the year of 9920 into October, November, December, 3 months. So that's going to be 3 by 12. So this is going to kick in as well. 9920 into 3 by 12. So that's going to be 2480 as well. So this point automatically solved over here. Then at the date of acquisition, the fair value of the silver company assets were equal to their carrying amounts, with the exception of two items. Okay, so the two items are an item of plant had a fair value of 2.6 million above its carrying amount over here. Okay, so we kind of sort of have this, higher fair value over here. The remaining useful life of the plant at the date of acquisition was 3 years. Depreciation is charged to cost of sales. So I'll simply go working to fair value plant. Excess fair value. It said that it had a high value of 2.6 million, that is 2600 over here. So I will write fair value plant 2600 over here, because this is something for the sake of the calculation of the goodwill. This is the fair value adjustment that I have to take into account. So 2600 is going to be coming in over here. And then I have the excess depreciation. So that's going to be 2600, and the life is 3 years. So I'm going to divide it with 3 multiplied by 9 by 12 over here. So I have to do this 9 by 12 as well. So this is going to be 2600 by 3 into 9 by 12. So I get this 650. And the question said that I have to charge the excess depreciation to as far as the cost of sales is concerned. So I'll go to the cost of sales. My cost of sales are 81,920 plus 41,600 into 9 by 12 plus I have this working 2. Yeah, working 2. And I have this 650 over here for the excess depreciation. So this is going to come in the cost of sales. So I'm showing it over here. Done? Okay. Then the second point, Silver had a contingent liability which gold company estimated to have a fair value of 850,000. Okay. So this has not changed at 30th September over here. So we have this contingent liability over here now. So this contingent liability is something that we have to, record over here as well. And as far as the calculation of the goodwill are concerned, these are the net assets over here. So if we get to have any contingent liability over here, we have to eliminate it. I mean, we have to minus it up, and this is standing at 850. So I'll go and I'll minus the 850 from my goodwill calculation. Similarly, this contingent liability of the 850, this is something which has to be accounted for over here as well. And this is something which has to be eliminated from the accounts as well, which we are now going to do over here, right? So we have recorded this over here. Now, if I move forward, the second point which we have, obviously we incorporated these over here, so it just says that silver company has not incorporated these fair value changes into as far as the financial statements are concerned. Then the third point is the gold company's policy is to measure the NCI at fair value at the date of acquisition. For this purpose, silver company share price at the date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. So if I go by over here, if I can write the fair value NCI, I can simply go over here and the total shares are the 16 million, 10% of the are of the NCI, and over here the share price is 3.50 over here. So this will be 16,000, 10% into 350. We get this 16,000. Oh, okay. Sorry. This was 3.5. Okay. So we got the 5,600 over here. So if we get this 5,600 over here, the total consideration is going to be this one, 106, 400 over here. Then we have the point number 4. Sales from gold company to the silver company in the post-acquisition period had been consistently at 600,000 per month. Gold company made a markup of 25% on these costs, and then silver company had 1.2 million of these goods in inventory over here. So this is the intercompany transaction and unrealized profit over here. So we have these sales cost profit. And this simply said that in the post-acquisition profit, we had 600,000 per month over here. So this is gonna be simply 600 into 9 months. So we have into 9, we get 5,400 over here. And then it says markup is 25%. So we have a markup. Markup is on cost. So this is going to be 125%. So my profit element is going to be 1080 over here. Now, still in inventory is 1.2 million. Silver company had 1.2 million these goods in the inventory. So this is going to be 1.2 million divided by 5.4 million. So that's going to be, so in terms of percentage, this is around 22.22% still in inventory now. So the unrealized profit is going to be 1080 multiplied by 22.22%. So you get 1080 over here multiplied by this, you get this 240 over here, and this 240 is your unrealized profit over here. Now, as far as the workings are concerned, this is the sales. We have to eliminate the intercompany balance over here. So we'll go into the revenue. We'll give the revenue working 3. Okay, reference. So the revenue over here is 103,360 plus 60,800 into 9 by 12 minus this 5,400. So I'll minus this 5,400 from here. I'll go over here. I'll give the reference of now working 3. I will minus this 5,400 and I will add the unrealized profit of 240 over here, right? So 240 unrealized profit is added and this 5,400 intercompany selling price is deducted, and same from the revenue. Now this is going to be 100% typical adjustment that you will come across as far as your the question in the paper is concerned. If you get to have as far as the consolidated statement of comprehensive income is concerned. So this is something 100% I'm sure that the examiner would like to and would love to test this adjustment over here. Now, moving ahead, gold company's income from investment is a dividend received from its investment in a 40% owned associate, which it has held for years. The associate made a profit of 3 million for the year ended 30th September 20x2 over here. Now, technically over here, this is the dividend received from as far as the associate is concerned, right? And if I look over here, if I go up, income from investments, this is 800 over here. So I will go into my working for income from associate over here. Now, it's simple. Profit share of, or the profit of associate multiplied by percentage holding. That's it. This is what you have to do. So if I go, the profit for the year is 3 million and this is 40%. So that's going to be simple. 1,200 over here. So I will simply go under the operating profit and I will write share from associate or profit share from associate, and I'm going to put in the working number 4 over here, and that's 1,200 over here, right? Okay. Then point number 6, on 1st October 20x1, gold company issued $100,000 6% convertible loan notes at par with interest annually payable in arrears over a 5-year term. The equivalent rate of the convertible loan notes was 8%. Gold company has recorded the loan note as a liability at par and has charged the 6% interest expense from the borrowing and the lease liabilities over here. Okay. So basically over here, this adjustments calls for, if we issue a convertible loan stock, this is something you guys are familiar, we have to adjust it, and we have to adjust it over here from as far as the presentation point of view is concerned, because if we have a convertible loan stock, we have to change it and we have to adjust it over here with the splitting of the equity portion and the debt portion over here, right? So this is what we are going to do over here at the moment. So I'm going to go in the working 5, and this is going to be called as the convertible loan notes. Now, for the convertible loan notes, we will have the number of years, cash flows, discount rate, and then the present value. Right? I'm gonna show you what do I mean by these. Now, if I go, I issued an X1 and the term is basically 5 years over here, right? So these are the 5 years over here. So from year 1 to 5. So from year 1 to 5, you will have the cash flows over here, and you are going to have the cash flows, and this is the 6% convertible loan stock now. So the total value is basically, look, 100,000 into 100 now. So this is 10 million. So technically speaking, you'll have rounding of 10,000 over here. So this is 10,000 into 6% over here. So we get for the 5 years consecutive amount of 600 per year. So we'll have the annuity factor at the 6%, and that is going to be say one is my discount rate over here. So the present value is going to be 409 for this. Okay. Now moving ahead from here, okay, I had to put up the annuity factor, my bad. Okay, so the annuity factor for this was 3.993. Okay. Now, in the 5th year, I will I will be doing the repayment over here. So repayment is basically the 10,000 over here. And for this, the discount rate is gonna be 0.681. Okay. And this is going to be this into this 6810 over here. Done. And then I am going to have its total value over here, and the total present value is going to be 9206 over here, right? So effective interest rate on loan notes is going to be 9206 multiplied the effective interest rate. If I have to go, that is going to be the 8% over here, and that's going to be 9206 multiplied by 8%, so that's going to be 736 over here. And it says the company has already charged a 6% interest expense from the borrowing and the lease. So company has already charged the 6% over here, and that is on the 10,000. So that's a 600. So now the more chargeable is going to be 136 over here, which we have to charge more. So if we go up again in the interest expenses column, so we have the interest expense on borrowing and lease, that is 672 over here. Interest expense on borrowing and lease, that was working 4 and working 5 over here. So that is working 5, and that was 672 plus 136. 672 plus 136 over here. So that's going to be 808 over here. Okay. Now, point number 6 done. Then there is no impairment of the goodwill. Okay. And then the profits have evenly accrued throughout the year. Done. We are done with this. Now, moving ahead from here, we had this calculation of the goodwill over here. Now I'm left with the share capital over here. Share capital is $16 million, $1 share. So that's going to be what? 16,000 over here, right? So I have this over here. So now if I go out and do the sum, I get 76,230 over here. So the goodwill is going to be 30,170 over here. This is the goodwill. Now, I'll go as far as the income statement format is concerned. I got the revenue and the cost of sales. Now, as far as the selling expenses are concerned, I have 2560 plus 2980 into 9 by 12 over here. For the journal expenses, I have 6080 plus 3740 multiplied by 9 by 12. This one. Then I got the profit share of the over here, and then this was the income from associate already accounted for. Profit before financing, okay, the interest expense accounted for. Income tax expense. So I have 4480 plus 2560 into 9 by 12. Done? Okay, I'm now gonna go over here. This is 103,360 plus 60,800 into 9 by 12 minus 5,400. So I get this. Then I have this over here 81,920 plus 41,600 into 9 by 12 plus okay, this is the excess depreciation, so I was supposed to minus this up 650. Then I will minus the 5,400 plus the 240 over here. Okay, so I got this 107,310 over here. Let's cross check. This is 81,920 plus 41,600 into 9 by 12. Then this 650 is supposed to be minus. Then I have to minus this over here as well, and then the plus 240 over here as well. Okay, then yeah, this is fine. Okay, so this is the excess depreciation. Yeah, so we are going to have this 108,610 over here as well. So when we are going to net it off, we are going to get this 34,950 over here as our gross profit. Then we have this 2560, and this is going to be 2980 into 9 by 12, 6080 plus 3740 into 9 by 12, and then we are going to get our operating profit 21 over here 270. Then we have the profit share for the 1200. So profit before the financing and income tax is this. Then we have these two interests over here. So this is going to be 3184 over here. And then we have the profit before income taxes over here. So 19,286. And income taxes are 4480 plus 2560 into 9 by 12. And then I have this 12886 over here. This 12886, this is something which is to be attributable to as far as the NCI and the group is concerned. So over here, if I talk about the sharing to as far as the NCI is concerned, this is going to be simple over here. Look at the profit for the year. This is going to be 9920. So this is 9920 into 9 by 12 over here. First thing first. And then from that, we just have to minus. And there was only one thing. This was the excess depreciation over here, nothing else. So we'll minus the 650, right? And then the NCI has a 10% holding, which we will minus from here as well. So this is the total adjustment that we have. All right, so I'll simply go over here and this is 9920 into 9 by 12 minus 650 and then into 10%. So I get my 679 over here, and the group balance is going to be the balancing figure. This is this minus this. So we'll have for the group as far as the 12,207 is concerned. Done. So this is what we have. Now, let's just take a break of like around 4, 5, 7 minutes or so. We're going to come back and then we'll resume with as far as the next question is concerned. Let's have a break. Okay, now the next question over here that we have is basically this third company over here, and this is what we are going to have over here. Let me just clear the drawings. Okay, now we are good to go. Now, the third company, the scenario relates to the two requirements over here. We have the third company over here, we have the Sebastian company over here. And if we go down after the point number 1, 2, 3, 4, 5, 6, we get a requirement. Prepare the consolidated statement of profit and loss and other comprehensive income over here for the third group, and then calculate the total assets that would be recognized in the statement of financial position. So we don't have any goodwill calculation over here. The best thing. Okay, now again, the rule is simple that you have to create a format over here, right? Okay, so for sake of the format, the rule is same that we have to create a box and then we have to start. So we have this whole format being pasted over here. So let's start now. This scenario relates to two requirements. A third company acquired 80% of the Sebastian company on the 1st April 20x6. Right, so non-controlling interest is measured at the at the fair value. Now this is on 1st April, so the first year end is going to end on the 31st March 20x7, and then the other one on x8. So it's all fine. We don't have to time portion the results of the subsidiary over here. Now I'll just scroll down over here and I'll start off with these points over here for the sake of the adjustments and all, right? And the cost of the third company's investment in Sebastian has been excluded from the total assets listed above. Okay. So these are the total assets. So basically the investment, the cost of investment that we have, it's been excluded from here. Okay. As a part of the consideration for the Sebastian company, 8 million is due to be paid on the 1st April 20x8. Okay. Third company recorded a liability of 7.547 million in its individual statement of financial position at 31st March 20x8 and 20x7, which correctly represents the liability at that date. No other accounting entries have been made in relation to this consideration for the year ended 31st March 20x8. Third company has a cost of capital of 6%. Okay. Now, if I go down, the part B, calculate the total assets that would have been recognized in the consolidated statement of financial position. So this is the point that we have to do. So I'll go over here and I will write the calculation of total assets for consolidated statement of financial position. And I will write this up over here. And with this part, I will write total assets of third company. They are 297,310. Then I will write total assets of Sebastian company. And they are 110,540 over here. This. That. Now, in this, I have not recorded as far as the deferred consideration is concerned, because I have not recorded this overall speaking, 8 million. This has to be recorded over here. So the cost of the third company's investment in the subsidiary has been excluded from the total assets over here. Now, the point basically over here is this thing is basically going to be used for the calculation of as far as the goodwill is concerned, right? Because I will have to do the calculations for the goodwill to be accounted for over here as well. So the working one, I am going to assign it for the sake of the goodwill over here that I will have to do over here, right? So as far as the calculation of the goodwill is concerned, this is simple, that I am going to, you know, take into account as far as the goodwill calculation is concerned. And for the sake of the goodwill, if I go, this will be, I'll be doing the workings over here. So this is going to be the goodwill working one. So I have my cost of investment over here. As a part of the consideration, 8 million is due to be paid on 1st April. Okay. And on acquisition of the Sebastian company, the goodwill was correctly calculated at 3.2 million. And in the year, the goodwill was deemed to have been impaired by 400,000 over here. Okay, so we have the goodwill figure over here. And the goodwill is 3.2 million. That is 3,200 less impairment over here in the current year. And the impairment in the current year is basically 400 over here, which I will minus from here. So I will have my net goodwill over here. So that is 2,800. Done. So I'll simply go up, and this goodwill, I will record it up at 2,800 over here, because I had to, like, account for the impairment over here, right? So I will have this over here. In the year to 31st March 2087, the goodwill was deemed to have been impaired by 400. So I've accounted for this 400 over here. Done. So we have this Zephyr company question now. And if we scroll down, the simple requirement is to prepare the consolidated statement of profit and loss of the Zephyr Group for the year ended 30th September 2023 over here. So I'm just going to go over here, and I am going to drag it down up till this 35. It's going to be more than enough. I'm going to zoom and merge it here. So this is Zephyr Group consolidated statement of comprehensive income for the year ended, and then we have the date at 30th September 2023. So 30th September 20x3 over here. So we have the sales, we have the cost of sales, we have the gross profit, then we have the operating expenses. After the operating expenses, we have this operating profit over here. After the operating profit, we have investment income. Then we have profit before financing and income taxes. Financing and income taxes. So we have now interest expense. So then we have the profit before income tax. So we have income taxes, we have income tax expense, and after that we have the profit for the year over here, right? Then we are going to have the other comprehensive income or something that we are going to have, and then eventually at the end we are going to have attributable to group NCI, and then total over here, right? And then we are okay. So on 1st October 20x0, Zephyr acquired 75% of the equity shares of Shem, and then 80% of the equity shares of the Jack over here. Okay, so on the same date, on 1st October 20x0, right? Now this is the 30th September 20x3, so technically speaking, they have been acquired way, like, before the start of the year, so we don't have to time a portion or anything. Then on 31st March 20x3, Zephyr sold its entire shareholding in Shem for 6.2 million. Okay. So on 31st March, we have sold the entire shareholding in Shem over here. So 6 months, right? So we have to time apportion the results of the Shem over here, and then we can have the profit from the continued and the discontinued operations over here as well. Okay, so we have to segregate it up over here, right? And the summarized statement of profit or loss for the three entities for the year ended 30th September are, we have these over here. Okay. Now, the point number one, as we always do, we are going to solve these points and eventually the whole question is going to be solved. At 1st October 20x0, when I acquired, the fair value of the net assets of Jacko were equal to the carrying amounts, with the exception of an item of plant whose fair value exceeded its carrying amount by 400,000. At this date, the remaining life of the plant was 5 years. All depreciation is charged to cost of sales over here. So I'm going to go over here. I'm going to have this working one, fair value depreciation over here. So excess fair value was 400,000. Life is 5 years over here. So excess value 400,000. Then we are going to have life is 5 years over here. So current year adjustment is going to be 400 by 5, and that is 80 over here. So I have the sales 70,000, and Jacko's 15,000. Then I have the cost of sales 34,000 for the Zephyr, and then we have 800 plus. This is the 80 and working one over here. Then in point number two, in the year ended 30th September 2023, Jacko sold goods to Zephyr Company for 1.2 million at a margin of 30%. 300,000 of these goods were still in Zephyr's inventory at 30th September. So we have this working to intercompany balance and unrealized profit over here. So I have my sales cost profit. So I have 30% margin. Margin is on sales, so that's going to be 70%. And then I sold the goods for 1.2 million. So I am going to have this total profit over here. Then I will have still in inventory is 300,000, which is going to be 300 by 1200. So we are going to have 25%. So my unrealized profit 360 into 25% at 90 over here. I'm gonna go over here. Mine is the intercompany selling price. The intercompany selling price is 1200. Done. I'm gonna go over here. Intercompany selling price is 1200 and the unrealized profit is 90 with the reference of working 2 over here. Then I have the third point On 1st October 20x0, the fair value sham assets were equal to their carrying amount of 3.8 million over here. So we have sold the net assets over here. Zephyr company values the non-controlling interest in its subsidiaries as a proportionate or the proportion of the subsidiaries net assets over here. Then at 1st October 2022, Sham's net assets had a value of 5 million and goodwill in Sham, okay, had been impaired by 200,000. The goodwill of the Jacko was deemed to be unimpaired, and the disposal of the Shem satisfied the conditions to be treated as the discontinued operation according to the IFRS 5. And no entries have been made in respect of this. Okay. So now I'm gonna go in my working three. This is going to be the profit on disposal of subsidiary from group's point of view over here. So we have the sale proceeds over here. I have sold for 6.2. So that's gonna be 6,200, right? And then I am going to add fair value of retail interest, which is none. I am going to less net assets of Shem at disposal. So on 1st October, the net assets had a value of 5 million over here. Plus, if we look, the profit for the year for the Shem is 4,800 into 6 by 12 is what we are going to have over here. So the net assets at disposal 5,000 plus 4,800 by 2. So that's going to be 7,400 over here. Then we'll have the unimpaired goodwill over here. So we have just this information that this goodwill has been, the goodwill in the Shem had been impaired by 200,000. We don't have any goodwill that what the goodwill of the Shem was. I haven't seen or read anywhere. So let's calculate the goodwill. Working for goodwill in Shem. So we have cost of investment. I got okay 75. The fair value of the consideration paid was 3.5 million for Shem. 3.5 million means 3,500. And we are going to have okay. So Zephyr values the non-controlling interest in its subsidiaries as a proportion of that of the subsidiaries net assets over here. So non-controlling is calculated as a proportion of the net assets method over here. Okay. So we are going to have the not add but rather less the net assets at acquisition because we don't have any other information over here. So let's see what were the net assets at acquisition. So I have this 3.5 million over here. And this is the profit over here. The fair value of the net assets were Jacko were equal to the carrying amounts. Okay. Jacko sold, and then at 1st October, the fair value of the Sham's net assets were equal to their carrying amounts of 3.8 million over here. So we have net assets at acquisition of 3.8 million or 3,800 over here, right? And we own 75% over here. So we are going to have its 75% share. So this is going to be 3,800 into 75% is 2,850. So goodwill in Sham is going to be this 650 over here, right? And then we have the impairment in goodwill, which is 200,000. So I'm going to minus this 200. So goodwill disposal is going to be 450. So my unimpaired goodwill is going to be the 450 over here. So I will have this 450 over here. Then I have my, this unimpaired goodwill over here. From this, I am going to less my NCI at disposal. So that's going to be the 7,400, the net assets at disposal. I'm simply going to take its 25% now because that's not something mine. So 7,400 into 25% is going to be 1,850, which I am going to now less from here. So I have the profit on disposal of 200, right? So I have my profit on disposal over here on as far as the the profit on disposal of uh the subsidiary is concerned, right? So this profit on disposal is something that I am going to record in my accounts over here, right? So this is the profit on the disposal from subsidiaries point of view over here, right? And then this is something I am going to have the profit on disposal of subsidiary, and this is something in my working 3 over here, and this is 200 over here that I'm going to take into account over here, right? The next thing in line, what I have to do is that I have to now calculate the 6 months results over here, and then now I am going to have another working, and this is going to be the profit from discontinued operations. So I have this for 6 months over here now. So I have Shem's profit at disposal date. Now, if I look, Shem's total profit is 4,800 over here. 4,800 into 6 by 12, that's gonna be 2,400 over here, right? And my share is basically this 2,400 that I have over here now, right? So total profit from this continued operation, my share, that's gonna be 2,400 over here. So I'm gonna go up. This is going to be my profit for the year. Now I'm going to write profit from continued operations. Then I will write profit from discontinued operations working 5, and that's gonna be 2,400 over here, right? So I will have this 2,400 over here, and then I will write it as the total profit for the year over here. Now let's just go and post it up. We have 70, 15, 1,200. We have 34,000, 8,800, 80, 1,200, 90. Right? So we have a gross profit of 42,030 over here. Operating expenses 18,000 and 1,200. 18,000 and 1,200 over here. So that's going to be 19,200 over here, right? So we have the operating profit. Okay, so this operating profit is going to be 22,830 over here. And we're going to have this figure over here. Do we have any investment income? No, we don't. We don't. So profit before financing and income taxes. So we are going to have this 23,030 over here. Interest expense, I have 2,400 and 600. 2,400, 600. So we have this what 3,000 over here. So yeah, income tax expenses on gonna be over here. No. Oh, this is not my income tax. My bad. My bad. This is over here. 2,400 plus 600. This 3,000 gonna be deducted from here. So I have my profit before income tax. 2030 over here. Now I have my income tax 4,800 and 800. 4,800 and 800. 4,800 and 800 over here. So my profit from continued operation is going to be 14,430 over here. And then my total profit for the year is going to be 16,830 over here. Right now, this is going to be attributable to the group and all over here. So the total is 16,830. Now I am going to have the adjustment over here for as far as the NCI is concerned, and it's better to go in the working. I have the working 6 over here for the NCI. Working 6 share of NCI over here. So I have the Shams profit to date of disposal. Shams profit is 4,800 into 6 by 12. So that's gonna be what? I don't have any adjustment in the Shams now. So let's just go and do it directly over here. I own 75. So 25 is for the NCI. So 4,800 into 6 by 12 into 25% is what I'm going to have over here. Then I have my Jacko's profit for the year, right? So let's have one more working column over here. The Jacko's profit for the year is 3,600 over here. Now we had a fair value excess depreciation. I did this fair value depreciation over here. So 80 is going to be deducted from here. Then I had this unrealized profit of 90. Unrealized profit working to 90 is what I am going to deduct from here as far as the fair value excess depreciation is concerned. That's going to be working 1 over here. So I have a total amount NCI share. I own 80%, so that's 20%. So this is gonna be 3,430 into 20% over here. So then my non controlling interest, that's going to be 1286 over here. So I'm going to go here 1286. So we have this 15,544 as far as for the group is concerned, and I am going to write it as a balancing figure over here, right? So this is how you are supposed to take this question, okay? A straightforward, relatively simple question, and I guess easy question with not so many adjustments over here. Okay, so we have this next question over here. This is of the PERD company. This scenario relates to two requirements, and then we have this PERD company acquired 80% of the Sebastian on 1st April 2026, that is 2 years ago. So non-controlling interest is measured at the fair value, and then we have the extract over here for the year ended 31st March 2028. I have taken the liberty to make up the format over here as well. And if I go down, the first requirement is for the consolidated statement of profit and loss, and then the other requirement is the calculation of the total assets that would be recognized in the consolidated statement of financial position of the PERD group at 31st March 2028. So I will write this as total consolidated assets for or total consolidated asset as at 31st March 20x8 over here. So we have total assets of Word company. They are 297,310. 297,310. Then we have total assets of Sebastian company, and they are standing at 110,540 over here, right? So they are at 110,540 over here. Then, as the question move forwards, the following information is relevant. The cost of the per investment in the Sebastian company has been excluded from the total assets listed above. Okay. So as a part of the consideration for the Sebastian company, 8 million is due to be paid on 1st April 20x8. Bird company recorded a liability of 7.547 million in its individual financial statements position as of 31st March 2027, which correctly represents the liability at that date. No other accounting entries have been made in relation to this consideration for the year ended 31st March 2028. PERD company has a cost of capital of 6%. So working one over here is going to be start in the individual account. This is basically 7547 over here. So 7547 is over here. And then we'll have the unwinding of discount. And the unwinding of discount is going to be at 6%. So this is going to be this into 6% over here. So we have this 453 over here. And this 453 is basically going to be the unwinding of discount of the interest expense over here. Right. So I'll just go up as far as my profit before after profit before financing and income taxes over here. So I will just simply write it as the interest expense on deferred consideration. That is the working one, and the amount is 453 over here. Done. Okay, next line. On acquisition of the Sebastian company, the goodwill was correctly calculated at 3.2 million. Okay. So in the year to 31st March, the goodwill was deemed to have been impaired by 400 And then a further impairment of 300,000 is to be recognized for the year ended 31st March 20x8. Impairment losses are not considered material and are presented in the operating expenses over here. Okay. Now over here, I will write the goodwill in Sebastian. I will record the goodwill over here in total amount, which is 3.2 million. So I'll record 3,200 less impairment over here. So at first this was 400, in the current year this is 300. So 400 plus 300, I'll minus the 700 from here. I'll go to my operating expenses in the consolidation, and over here this is 18,040 plus 12,230. My plus, not minus, plus, because this is an expense, we have to add the expense over here, and this is going to be 300 for that as well, right? So this expense is going to be added up over here in the operating expenses. Done. So it will be over here as well. Now, moving ahead from here, if we move forward, what is the next thing in line that we have? Then, at 1st April 20x6, Sebastian's property had a carrying amount of 11 million, okay, but a fair value of 14 million. Done. At this date, the property had a remaining life of 15 years. So Sebastian Company sold the property for 15 million on 30th September 20x7, making a profit of 5.1 million. And then for the year ended 31st March 20x8, Sebastian Company has recorded the historic cost depreciation in the operating expenses. And the depreciation is charged on a pro rata basis, and the profit on the disposal is presented as the operating income in the statement of profit and loss over here. Now, as far as this disposal entry and all and everything is concerned, technically speaking, Sebastian Company sold or disposed of as far as this property is concerned. Done. So, first thing first, the property had a carrying amount of 11 million on 1st April 20x6, right? When we acquired. And it had us on the same date, it had a fair value of this 14 million over here when we acquired technically, right? And this date, the property had a remaining life of 15 years. And then on 30th September 20x7, next year, or at the year end, Sebastian sold it, making a profit of 5.1 million over here. So this is the a bit of mixed scenario over here. So what you have to do over here is, technically speaking, the Sebastian Company, when it sold the property now, so Sebastian was already recording it up into his accounts or its accounts on the historical cost, right? So now what we have to do is we have to calculate the profit for Sebastian according to the carrying amounts that it had, right? So we have to, account it for on the carrying amount basically over here. Let me show you what I'm talking about over here. Let me go over here, working to profit on disposal of property. Look, the carrying amount of the property is 11 million. Carrying value of property 11 million. Depreciation charge for the year, because 1 year was gone, the property had a remaining life of 15 years. So this is over here. So value at year end, this was standing at 10,267 over here. And then this 10,267 is over here, right? So because if I go again to reconfirm, the property had a carrying amount of 11 million. Okay. At this date, the property had a useful life of 15 years. So Sebastian sold the property on 30th September 20x7. Ah, it sold on 30th September. So April to March, 1 year, and then May, June, July, August, September as well. So basically, these are the 6 months over here additional as well. So depreciation charge will be for 1.5 years over here. So this is 11,000 by 15 into 1.5. 9,900 is going to be the value at the time of disposal, right? Now, this company sold the property for 15 million. Okay. So disposal proceeds, they are 15 million over here. Meaning, if the disposal proceeds are 15 million over here, then the profit on disposal in individual accounts are gonna be 15,000 minus 9,900 of 5,100, right? So this is gonna be at 5,100 over here in the individual statement of profit and loss over here. Done? Now, the this is what the individual accounts are recording it. Okay, again. Now, the group profit on disposal would have been based on the carrying amount of the group over here, right? And if I talk about the carrying amount of the property in the consolidated accounts at 30th September, this would have been simply carrying amount from group's point of view. Now, if I talk about from the group's point of view, groups over here, the value is going to be the 14 million less depreciation charge. So this was what? Remaining life was 11 years? 15 years, sorry. 15 years into 1.5. So that is 1867 over here. So the carrying value at the time of disposal was 12133 over here. Okay. And the profit on disposal, this is what I have to calculate now, na? Because over here, the remaining life, 15 years. Okay. So I have the carrying amount over here. I got this wrong. This is 1.5 divided by 15 into 1.5. So I get 12,600 over here. And then the profit on disposal for the group. So profit on the disposal for the group, if I look over here, I sold it for 15 million over here, right? So this is going to be 15 million minus 12,600. So that is 2,400 over here, right? So from the group's point of view, the profit on disposal is going to be 2,400 over here. Similarly, if I look from the individual point of view, this is 5,100 over here. Now, when it comes towards as far as the adjustment in the accounts is concerned, right? I mean, if we have to do the adjustment related to this disposal is concerned, right? So this is going to be simple, that will be taken into account as far as the profit on disposal as an adjustment, right? We just simply have to take into account. So this is the profit on disposal. So I'll just simply go up other operating income, and then I can give the reference of this as the working two over here. And the working two, we are going to have the 2400 over here. All right. So this is going to be the 2400 over here. The profit from the group's point of view is concerned. I mean, if I go from the group's point of view, this is something that we are going to have over here. And this is something which was done on the 30th September. So over here in the total assets, this is already accounted for over here. Then moving ahead, Bird Company made sales of 9 million to the Sebastian Company during the year ended 31st March 20x8. Sebastian Company had only paid for the 2 million of these goods at 31st March. So these sales were made at a markup on cost of 25%, and Sebastian Company holds 1/3 of these goods at 31st March. Okay. Now, intercompany sales and unrealized profit over here. Okay, so I have my sales, I have my cost, I have my profit over here. And this is going to be over here. And this is going to be highlighted like this. So my bird company made so 9 million over here. Okay. So this is going to be the 9 million. Then the profit is, I guess, 25% markup. Markup 25%. Yeah. So this is going to be 100%, and this is going to be 125%. So 9,000 by 125 into 25, I get 1,800. Still in inventory, let's see. Hold 1/3 of these goods. Okay. So 1 by 3. So that means my unrealized profit is going to be 1,800 by 3. That is 600 over here. Right? Now, if I go up, this is the 9,000. So in the revenue, I'll go, and this is 58,200 plus 34,300 minus 9,000. For the cost of sales, this is gonna be 34,340 plus 20,400 minus the intercompany 9,000 plus the unrealized profit of 600 over here. And this is the working three. So I can put up the working three in the start for the sake of reference, that how I am bringing up the figures over here. Done? Okay. Next thing, at 31st March, the Port Group decided to revalue its non-current assets for the first time. Port Company assets were deemed to have increased by 4.1 million, and the Sebastian Company's assets by 0.7 million. Neither company has recorded the revaluation in its individual financial statement, so ignore the after tax over here. So now we have the revaluation gain of this 4.1 million and 0.7 million, which I'm going to record over here. So I'll simply go revaluation gain. This was 4.1 and 0.7. So this is going to be 4,100 and 700. So this is going to be 4,800 over here, the revaluation gain that I have to take up over here. Okay. Then moving ahead from here, the next thing is Sebastian Company paid a dividend of 1 million in the year, which has been recorded correctly by both the companies over here. So Sebastian has paid a dividend of 1 million, which has been recorded by both the companies over here. So technically speaking, the dividend has been recorded, which we have to eliminate from here. So if I go up, we have the income from investments 3 million over here. So the income from investment after the operating profit, the income from the investment is what we are going to bring in 3 million. And from that 3 million, we will minus the dividend from the associate and sorry, dividend from the subsidiary over here. And this is the 1 million. And we have the 80%. So we'll minus the 1080% from here, right? Because that is the intercompany balance over here. Afterwards, we are done with as far as the points and all and everything is concerned. Done. So let's move forward and see what do we have over here. So we got the revenue. Now, as far as the other operating income is concerned, we have a 5,100 over here. This is the other operating working, other operating, income over here. Okay. So we have this other operating income over here. We have already accounted for the 2,400 over here. So it's done. And then we have the operating expenses accounted for over here. And okay, let's do the total simultaneously. So this is 58,200, 34,300, 9,000 minus from here. Then we have 34,340 plus 20,400 minus 9,000 plus 600 as well. So that's going to be 46 over here, 340. So we'll get our gross profit of 37,160 over here. Then, as far as the operating expenses are concerned, we'll have 18,040, 12 to 30, and 300 as well. So that's going to be 30,570 over here, right? Then we have the income from the investment over here. The income from the investments is going to be 3,000 minus 800 over here. So that is the 2,200. Then we have the interest expense on the deferred consideration accounted for. Then we have the interest on the borrowing and the lease liabilities. So the interest expense on borrowing and lease liabilities we have over here. So this is going to be 3,240, right? And then we have 1,600 over here as well. So this is 3,240 plus 1,600. So that's going to be 4,840 over here, right? Okay, so we'll have this sum outside as well. Then we have the income tax expense over here. This is 1,560. And then we have 1,480 as well, right? So this is going to be 1,560 plus 1,480. We get 3,040 over here. So moving ahead from here, let's solve this up now. We are going to have this 8890 over here. After that, we got the income from the investments, right? So if I go the profit before the financing and income tax, this is going to be 11,000 over here, 11,090, and then my profit before income taxes is going to be 5,797, and then my income tax expense is 3,040, which I'm going to minus, so I get 2,757 over here, right? Then this 2,757, if I talk about as far as attributable to the NCI and the total is concerned, this is where I will have the working as far as, you know, for the group is concerned. And we can simply, you know, talk about this one over here in the context of what adjustments are to be done as far as for the NCI is concerned. Now, the NCI, which we can put up over here, the profit for the year, this is 3690, right? So 3690 is going to come in over here. Then, as far as the adjustment for the profit on disposal is concerned, this is the disposal from the group's point of view. This is the disposal from the individual point of view. So this adjustment has to be done 5100 minus 5400, 5100 minus this 2400, nah? So this adjustment is required, right? Then overall speaking, we are going to have the fair value adjustment over here as well. And then we have a goodwill share or the goodwill impairment over here as well. And then eventually we hold the 80% and this is the 20% over here. So if I go and I solve it up, I get 3690 minus 5100 minus 2400 minus 100 minus 300 into 20%, I get this 118 over here. And then for the group, the balancing figure is going to be 2757 minus 118. So that's going to be 2639 over here, right? So this is how the at the end of the day, we have to tackle as far as this question, the board group is concerned, right? So I hope this is clear, right? And this is what we have overall speaking as far as from the consolidation point of view is concerned. So I hope it's clear and everything is, kind of more clearer to you now. And as far as this practice, this whole session is concerned, and it's helping you out over here as well, right? So this is what I have over here for the session one. Now I am going to meet you again in the session two. And in the session two, we'll talk about multiple more examples, more questions to come in over here. And then we'll see and we'll talk about that, how we can move forward and we can, improve the things. So over there, my primary focus is going to be on the final accounts questions. I'll be talking to you about the individual standards as well. And then again, I will be talking to you about as far as the interpretation, the most important part as well. So stay tuned and then we'll move further into that as well. So till then, take care of yourself, your family, your friends, and the people around you, and a very best of luck for the preparation as well. And meanwhile, if you come across any problem or something, you can always reach out to us onto the Academy's portal. Till then, take care. Bye bye.